Please like, share, and subscribe. Wishing you happiness and good luck every day.
Okay, so today we're cracking open a true classic in the world of finance, Jack Schwager's Market Wizards. Now, this book, it's not about some secret stock tip or a magic formula. Nope, it's a deep dive right into the minds of some of the most successful traders on the planet. I'm talking about people who pulled off results that, honestly, most people would say are completely impossible. So yeah, our source today is the book itself, and we're going to pull out the absolute best lessons from these legends. This really is the ultimate question, isn't it? And it doesn't matter if you're a pro day trader or, just trying to keep your retirement account growing. Everybody wants to know the answer. Is there actual skill to this? Or is it all just dumb luck? Well, the academic world, they have a pretty strong opinion on this, and let's just say it's not exactly encouraging. And that strong opinion? Well, it's called the efficient market hypothesis. It's a huge idea in finance, and it basically says this: all the information out there, it's already priced into a stock, instantly. So let's say a company is about to drop an amazing earnings report. The theory says the market already knows, or at least anticipates it, and the price has already moved. So the bottom line, according to this theory, if you do beat the market, you just got lucky. It's a statistical fluke, just random chance. Okay, but what if that whole theory is wrong? Or at least not the whole story? What if there are people out there who, through sheer skill, incredible discipline, and just a totally different way of thinking, what if they can beat the market? And not just once, but consistently, year after year after year. Well, that's exactly what author Jack Schwager set out to find. He went looking for these people, the outliers, the exceptions to the rule, the legends, and he gave them a name: the Market Wizards. All right, so here's our game plan. We're going to look at how these wizards pretty much busted the myth that you can't beat the market. Then we'll get inside their heads and unpack their mindset. After that, we'll see how they handle risk and the whole psychological game. Then we'll cover the big one: consistency. And all of that leads us to the final, most important lesson: finding your very own path. So what really separates these elite traders from everyone else? If you're thinking it's some secret indicator on a chart or a super complex algorithm, I've got to tell you, you're in for a surprise. Because the secret, it isn't a method. It's all about their mindset. This is what Schwager figured out, and it's absolutely crucial. He talked to all these incredible traders, and their styles were all over the place. I mean, you had guys who were deep dive fundamental analysts, poring over balance sheets for years. Then you had pure chart junkies, technicians who didn't care about anything but the price. Some held trades for months, others were in and out in minutes. Their methods were complete polar opposites. But here's the kicker. Schwager realized the one thing they all had in common wasn't how they traded, but their attitude. And this quote from Marty Schwartz, man, it just nails it. He said, "I became a winning trader when I was able to say, to hell with my ego, making money is more important." Think about that. For years, this guy struggled because he was always trying to prove he was right. His ego was driving the bus. But his big aha moment was realizing his ego was the enemy. The goal isn't to be right. The goal is to make money. And that means you have to be able to look at a trade and say, "Nope, I was wrong," and get out. Fast. No drama, no emotion. Just out. So the psychologist Dr. Van Tharp actually dug into this and found some common beliefs among these top traders. And they're really interesting. First, money isn't the most important thing. It's just how you keep score, like in a game. Which leads to the next one. It's okay to lose. A loss isn't a catastrophe, it's just part of the game. They also use mental rehearsal, running through scenarios over and over, so when things get crazy, they're not panicking, they're prepared. And that last one is huge. They've won the game before they even start. Why? Because they have a solid process, and they trust themselves to follow it, no matter what. And that brings us to this kind of mind-bending quote from another legend, Seykota. He said, "Win or lose, everybody gets what they want out of the market. Some people seem to like to lose, so they win by losing money." Whoa, what on earth does that mean? Well, what he's getting at is our subconscious. He's saying if you're always losing, maybe, just maybe, you're getting something else you want. Maybe it's the thrill of the gamble, or the sympathy you get from others, or maybe you're even afraid of what success would mean. It's a really tough question to ask yourself. What do I really want to get out of this? Okay, so section 2, mastering risk and psychology. This is all about the emotional game. Because look, it's one thing to have the right mindset when you're just thinking about it. But what happens when your hard-earned money is actually on the line? Yeah, that's where things get real. And that's where the wizards really show how they've mastered the emotional roller coaster. And this chart just lays out the biggest psychological trap perfectly. Here's how it works. Winners cut their losses short and let their profits run. Losers do the exact opposite. They let their losses run and they cut their profits short. And here's the crazy part. We are all naturally wired to be losers. It's human nature. Our instinct is to grab a tiny little profit because we're afraid it'll disappear. And with a losing trade, our instinct is to hold on, just hoping and praying it'll come back to break even. The market wizards, they learned how to completely override that instinct. They literally forced themselves to do the exact opposite of what feels natural. And here's Marty Schwartz again, just drop in another truth bomb. He asks, why do most traders lose? His answer, because they would rather lose money than admit they're wrong. Think about that. When you let a losing trade just sit there and get worse, that's not a financial decision. It's an emotional one. It's 100% about your ego. It's about not wanting to admit you screwed up. But a successful trader, they don't tie their self-worth to a single trade. A loss isn't a personal failure. It's just the market telling you, hey, your idea was wrong, move on. Okay, next up, the cardinal rule, consistency. So let's say you've got the mindset down. You've got your risk management plan, great. But you know what? None of that matters. I mean, none of it, without this one ingredient, discipline. The ability to follow your rules relentlessly day in and day out, no matter how you feel. But that raises a huge question, right? Is that kind of discipline something you're born with? Or can it actually be taught? It's that classic nature versus nurture debate. Are these wizards just built different? Or is trading a skill that anyone could learn if they had the right teacher? Well, one of the most famous stories in the entire book gives us a pretty shocking answer to that question. It all starts with this quote from a legendary trader named Richard Dennis. He said, "We are going to grow traders just like they grow turtles in Singapore." Sounds weird, right? Well, he had just made a huge bet with his business partner. Dennis believed he could take regular people with zero trading experience, and turn them into superstars. And yeah, the whole idea was inspired by a turtle farm he saw on a trip. So here's what he did. Dennis put ads in the newspaper and hired a whole group of people from totally different backgrounds. I'm talking a security guard, a musician, an accountant, a real mixed bag. And he called them his turtles. Then he taught them a complete step-by-step rule-based trading system. There was no guesswork. It told them exactly when to buy, exactly when to sell, and exactly how much to risk on every single trade. And the result? It was absolutely mind-blowing. The turtles went on to make hundreds of millions of dollars. It was definitive proof that trading wasn't some magical gift you're born with. It was a skill, and it could be taught. But here's the real lesson, and it comes from Richard Dennis himself. He said, "I always say that you could publish trading rules in the newspaper and no one would follow them. The key is consistency and discipline." So the rules themselves, they weren't some big secret. He's saying he could literally print them for the whole world to see and it wouldn't make a difference. Why? Because knowing the rules is the easy part. The hard part, the part that really makes the difference, is having the guts and the discipline to follow them, especially when you're losing money and your brain is screaming at you to just do something different. All right, our final section, finding your own path. This is the ultimate secret. And this brings us to what might be the most powerful lesson in the entire book. Because if the secret isn't the rules themselves, then what in the world is it? Well, remember how we said all the traders Schwager talked to were so different? Seriously, these guys were an incredibly diverse group. They argued about pretty much everything. Some thought fundamentals were everything, others thought they were garbage. Some loved chart patterns, others ignored them. They couldn't even agree on how long to hold a trade. It was crystal clear. There is no single right way to succeed. I mean, just look at the difference here. You've got someone like James Rogers on one side. This guy would spend months, sometimes years, doing super deep research on a company to see if it was a good value. And on the complete other end of the universe, you've got Ed Seykota. He's a pure trend follower. He thought fundamentals were just a bunch of noise. The only thing he cared about was what the price was doing on the chart. And here's the thing. Both of them made an absolute fortune. They were both wildly successful. And this is where Jack Schwager, the author, brings it all home. Years later, he reflected on the book and said this: "The quest is not a matter of finding that one approach that unlocks the secrets of market success, but rather of finding an approach that fits their personality." That's it right there. The biggest mistake people make is they try to copy somebody else. But if you're trying to use a system that just doesn't vibe with your personality or your comfort level with risk, you're never going to be able to stick with it. You won't have the discipline because it doesn't feel right. So the real secret, the actual holy grail of trading, it's not a formula you find out there somewhere. It's self-knowledge. The whole journey isn't about looking for a secret system. It's about looking inward. It's about figuring out who you are. What are your strengths? What are your weaknesses? What are your biases? Are you a patient person or are you impatient? Do you need tons of data or are you more intuitive? You have to answer those questions about yourself first, because that's how you find a method you can actually follow, whether you're winning or losing. And really, that's the final question the book leaves us with. What trading rules fit your personality? This isn't even just about the markets. This idea applies to pretty much any high-stakes field. The road to becoming great at something isn't about trying to be a perfect copy of someone else. It's about discovering the absolute best version of yourself. So you have to ask, what system, what set of rules actually fits who I am? And finding that answer, that is the real secret of the market wizards.
All right, let's just jump right in. We're going to talk about one of the most important, fastest growing, and honestly, one of the most mysterious financial arenas out there, the futures market. It's a world that a lot of people have heard of, but very few really get. So today, we're going to pull back that curtain and make it all make sense.
And hey, that's not just me saying it. This quote really nails it. There's this cloud of complexity that just seems to hang over the whole topic of futures. But the truth is, once you get the main ideas, it all starts to click. So if you've ever felt a little bit in the dark when the subject comes up, well, you've come to the right place.
So just to get a sense of the scale we're dealing with, just look at this number. That's $10 trillion. And that was the value of futures contracts traded in the U.S. in a single year, all the way back in 1988. Since then, the market has just exploded. This isn't some tiny niche corner of finance. It's a massive, powerful force in the global economy.
Okay, so what are people actually trading? If you're picturing things like pork bellies and corn, you're not totally wrong, but you're only seeing a tiny piece of the puzzle. As you can see here, agricultural stuff, which is where futures got their start, that's only about a fifth of the market today. The real giant in the room, at a massive 60%, is financial instruments. We're talking stock indexes, interest rates, currencies, in other words, the stuff that has a direct impact on your retirement account and your mortgage. So to really get a handle on all this, we're going to break it down into 5 key trunks. We'll start by moving past those old cliches. Then we'll get a solid definition of what a future actually is. We'll look at the 2 main types of people in the market, explore the 7 big advantages that pull traders in, and finally, we're going to tackle the most misunderstood topic of all, leverage.
So first up, beyond the cliches. As we've already started to see, this is not your grandfather's farming market anymore. The sheer size and the big shift towards finance have completely remade this world.
And that leads us right to our second section and the big question: what on earth is a future? Let's just strip away all the jargon, because the idea itself is actually pretty simple. At its very core, this is it. A futures contract is just a standardized agreement to buy or sell something at a price you both agree on today for a specific date down the road. The 2 most important words there are standardized, which just means all the contracts for, say, crude oil are exactly the same, and future, which is, well, obviously where it gets its name. So why would anybody want to do this? Let's take a really practical example, a strategy called hedging. Imagine you're an auto manufacturer. You know you're going to need a ton of copper 6 months from now, and you're worried the price is going to shoot up. So what do? You buy copper futures contracts today to lock in the current price. Now, if copper prices do go up, yeah, the cost of the actual metal is higher, but you make a profit on your futures contract, and that profit helps cancel out the higher cost. You've just used futures to manage your risk. Pretty clever, right?
Now, think about it. For a car company to make that trade, there has to be someone on the other end of it. And that brings us to Section 3, the 2 sides of the trade. Every single transaction has 2 types of participants who are coming at it with completely different, really opposite goals.
On one side, you've got the hedgers, like our auto manufacturer. Their main goal? To reduce risk. They're basically using the futures market as an insurance policy against prices moving the wrong way. Then, on the other side, you have the traders. Their goal is the complete opposite. They want to profit from those price changes. They're the ones who are willingly taking on the risk that the hedgers are trying to get rid of, hoping they've bet on the right direction of the market. So if traders are the ones taking on all this risk, what is it that draws them to futures specifically? Why not just trade stocks? Well, that's what we're going to cover in Section 4, the 7 key advantages that make this market so attractive.
So why do so many traders love this market? Let's just quickly run through the 7 big reasons.
First up is all about access and efficiency. Because the contracts are standardized, you don't have to waste time finding a specific person to trade with. The exchange takes care of all that. That creates incredible liquidity,
which just means it's super easy to get in and out of your trades. And this next one is a huge deal for traders. You can go short or bet on prices to fall just as easily as you can bet on them to rise. There are none of the extra hurdles you have in the stock market. Next up, two massive financial reasons: leverage and low costs. Leverage, and we're going to dig way deeper into this in a minute, lets you control a really big position with just a small deposit. And your transaction costs? They're often way, way lower than buying and selling a whole bunch of individual stocks to get the same kind of market exposure.
And finally, we have simplicity and security. Getting out of a trade is as simple as making the opposite trade. It's that easy. And this is crucial. Every single trade is guaranteed by the exchange's clearinghouse. That means you never have to lose sleep worrying if the person on the other side of your bet is actually going to be able to pay up if you win.
Okay, on to our final section, and it is a big one. Leverage, the real story. We listed it as a huge advantage, right? But it's also the #1 reason this market has a reputation for being so risky. So let's get to the bottom of this.
This quote really says it all perfectly. Leverage is a two-edged sword. The very same power that can amplify your gains can turn around and amplify your losses just as fast. It absolutely demands discipline.
And this is the most important point I want you to take away. The high-risk reputation of futures isn't because the prices are inherently more wild than stock prices. They're often not. The risk comes from the undisciplined use of leverage. It's how leverage magnifies every single tiny price move. A trader who isn't disciplined can get completely wiped out by a totally normal move in the market. And this right here is a really common point of confusion. The word margin means something totally different in futures than it does in stocks. When you hear margin in the stock market, it's basically a down payment on a loan you're taking out to buy stock. But in futures, there's no loan involved. The margin is simply a good faith deposit, like a security deposit, that's held by the exchange to make sure you can cover any potential losses.
So as we start to bring this all together, just remember, futures markets don't exist in some weird alternate universe. The price of a futures contract is always going to stay incredibly close to the price of the actual asset in the real world. Why? Because if they ever get out of whack, traders instantly jump in and make trades that force them right back in line.
So here's the bottom line. Futures are just a different way to trade the world's most important assets. And when you remember that 60% of this massive market is in things like stock indexes and currencies, you realize a lot of futures traders are really just trading stocks, bonds, and currencies, just in a different format. And that means understanding this world really is relevant for every investor, even if you never ever trade a futures contract yourself.
Which leaves us with one last question for you to think about. Since these huge, incredibly active markets are so tightly linked to the stock and bond markets you probably already follow, what signals could they be sending? What can the action in the futures market tell you about the potential future of your own investments?
Welcome to The Explainer. Today, we're going to pull back the curtain on the engine room of the global economy, the interbank currency market. You know, it's this massive, invisible system that honestly touches all of our lives every single day, but it operates almost completely out of sight. All right, so here's the game plan. First, we'll get a feel for the market's crazy 24/7 nature. Then, we'll dig into the big problem it was built to solve. After that, we'll meet the two key players. You've got the ones looking for safety and the ones chasing risk. And we'll wrap it all up by revealing the one currency that pretty much rules the whole show. Okay. First things first, we have to get our heads around the sheer scale of this thing. You know those images of chaotic trading floors from the movies? Yeah, forget all that. This isn't one physical place. It's a decentralized, global network that is, and this is the key, always on. And this is what makes it so mind-bendingly unique. It's basically a perpetual motion machine for money. Like the slide says, it literally follows the sun. That means it never, ever closes. It's always open for business somewhere on Earth. And this visual just lays it out perfectly. As the trading day is winding down in New York, it's already heating up in Sydney and Tokyo. From there, it just flows seamlessly over to the big banking hubs in Europe, like London, before they hand the baton right back to the US to kick the whole cycle off again. It's just this constant moving river of currency. So, a 24-hour globe-trotting market. Okay, but why? Why does something this huge and complex even need to exist in the first place? Well, turns out it all boils down to solving one single fundamental problem that could absolutely wreck any international business. And here it is.
The problem in a nutshell: exchange risk. I mean, just think about it. We live in a world where a currency's value can jump up or down in a heartbeat. So if you make a deal today for a payment that you won't get for months, that's a huge gamble. That uncertainty is a major headache.
Okay, let's make this real with a classic example. Put yourself in this company's shoes. You've just locked in a huge $1 million deal. Awesome, right? Time to pop the champagne. Except you won't actually see that cash for 6 whole months. What could possibly go wrong?
Well, here's where the trap is. Let's say all your costs, your factory, your workers, are in Japanese yen, but your payment is coming in US dollars. If the dollar gets weaker against the yen during those 6 months, your $1 million payment suddenly buys you way fewer yen. That one little swing in the market could be enough to completely wipe out your profit. Poof, gone.
So, how does our manufacturer get any sleep at night? Well, this brings us to the #1 reason this market exists: to create a financial safety net. This is not about betting on the future, it's about nailing it down.
And the solution has a name. It's called hedging. Honestly, the best way to think about it is like an insurance policy against those wild currency swings. It's a tool that's designed to just take all that uncertainty right off the table. And this slide just breaks down the genius of it all so well. On the very same day they make that big sale, the manufacturer goes to the interbank market. But see, they don't want to trade dollars today. They want to lock in a price for the dollars they're going to get 6 months from now. So they get into what's called the forward contract. A bank gives them a fixed rate for the future, and boom! Just like that, the risk is gone. They know exactly how many yen they're getting, no matter what crazy things the market does. But here's the twist. For every company that's trying to offload risk, the market needs someone else who's willing to take it on. So, let's meet the other big players on this stage, the speculators. Okay, so unlike our very careful Japanese manufacturer, speculators are the ones who run towards risk. They're not trying to protect some existing business deal. Nope. They're placing pure high-stakes bets on which way they think a currency is going to move. And this comparison right here is absolutely crucial for understanding how the whole market works. You've got these two totally opposite forces in the same playground. The hedgers are the risk avoiders. They just want stability. The speculators are the risk seekers. They thrive on instability. And the crazy part is, you need both of them for the market to work. So just look at how they play the game. It's all about making bets. If a speculator gets a hunch that the British pound is about to tank against the dollar, they'll agree to sell pounds at today's price for a future date. They're hoping the price crashes so they can buy them back super cheap later to make good on the deal and pocket the difference. The entire trade is created out of thin air, just from a prediction. Okay, time for the last and maybe the most critical piece of this enormous puzzle. There's this one fundamental rule, this invisible foundation that underpins every single trade we've talked about. Doesn't matter if it's for hedging or for speculating. And there it is. This is a massive point, straight from the source material. It seems kind of hard to believe, right? But it's the absolute rule of the game. It doesn't matter if you're trading Japanese yen for British pounds or Swiss francs for Australian dollars. The deal itself is priced and settled in US dollars. What this means is that the US dollar is the bedrock of this entire global market. It's what people call the world's vehicle currency. So to trade between any two other currencies, you don't actually trade them directly. What you're really doing is selling the first currency for dollars and then using those dollars to buy the second one. It actually simplifies things tremendously because you don't need a direct exchange rate between every single currency pair on the planet. So what are the big takeaways from all this? Let's just boil it down. These 4 points really capture the essence of this incredibly complex but totally vital financial world. It's a non-stop 24-hour market. It's driven by two opposite desires, to avoid risk and the profit from it. And the whole thing is built on the foundation of the US dollar. And that leaves us with a really fascinating question to chew on. This entire global system, the very engine of world trade, it all depends on this delicate dance between the hedgers who want safety and the speculators who are willing to take on their risk. So what do you think happens if that balance ever tips too far in one direction? Thanks for watching The Explainer.
All right, let's jump right in. We're going to talk about the story of Michael Marcus, a trader who has one of the most unbelievable track records in the history of finance. But what makes his story so amazing isn't just the wild success. It's the string of absolute, complete, soul-crushing wipeouts he had to go through to get there. So just to give you an idea of the kind of numbers we're dealing with here, over a single 10-year stretch, Marcus took the company account he was managing and multiplied it by 2,500 times. No, that is not a typo. He turned $30,000 into $80 million. It's just staggering. And the result of that kind of success? Well, it completely transformed his life. The author who interviewed him for our source material describes visiting Marcus at his home in Southern California, which was this two-house complex sitting on a cliff overlooking a private beach, all protected by this insane military-grade gate. So you have to ask, how in the world does someone get from zero to, well, to that? The answer, funnily enough, starts with a series of truly terrible decisions. See, before he was any kind of market wizard, Michael Marcus was a brilliant student. I mean, he graduated Phi Beta Kappa from Johns Hopkins. He was on track for a quiet, respectable life as a professor. But then, he got a different idea, one that sounded a whole lot more exciting. So as a totally naive college student who had never invested a dime, Marcus meets this guy John, a junior at his school. And John makes this absolutely absurd promise. Marcus, worried that learning too much might give him cold feet, hires him on the spot. He becomes his personal trading advisor for $30 a week, plus free potato chips and soda. You can't make this stuff up. After a couple of quick losses, John comes up with what he calls a can't-lose trade in pork bellies. The logic sounded pretty good, so for the first time ever, they felt confident enough to leave the office and go out to lunch. Well, they get back, and Marcus has been almost totally wiped out. He says he'll never forget the sight of John just pounding his fist on the quote board, screaming this line in total disbelief. Turns out the entire idea behind the trade was completely wrong from the very beginning. Okay, so after that pork belly disaster, Marcus fires John. But the losing streak, that didn't stop. He scraped together some more cash and tried trading by himself. And what's so wild about this is just the pure consistency of the failure. His first 5 trades with John, and then his first 3 trades on his own. Every single one was a loser. He was wiped out. Again. Now, you'd think most people would have just quit right there, but Marcus figured he just hadn't gotten the hang of it yet. So he cashed in a $3,000 life insurance policy his late father had left for him, and this one decision led him to the single most defining event of his entire early career, the Great Corn Blight. And this right here, this is just the perfect setup for a classic tragedy. In the summer of 1970, a real corn blight hits the crops, and by pure, dumb luck, Marcus is on the right side of the trade. The very next summer, completely convinced he's a genius, he tries to do it all over again, but this time, he bets the farm. So in that first glorious summer, his $3,000 stake just explodes into $30,000. He called it a princely sum. He felt like he'd figured it all out, like he'd mastered the markets. He dropped out of grad school, moved to New York, and started telling people, rather pompously, that he was a speculator. He was absolutely on top of the world. But then the next spring came. He was so sure the blight had survived the winter that he bet everything he had, plus money he'd borrowed from his mother. The market just sat there, flat. Until one morning, he picks up the Wall Street Journal and sees this headline. The rumor was a complete fake. The entire reason for his massive bet was a fiction cooked up by traders on the floor. The corn market immediately went limit down. Marcus just sat there in the brokerage office, totally frozen, hoping for some miracle turnaround that, of course, never came. By the time he finally sold the next morning, he had lost it all. Not just his $30,000 profit, but another $12,000 of his mother's money. He was completely wiped out, deeper in the hole than he'd ever been. And this is the crucial point, right? That catastrophic loss, it wasn't just about the money. It was a profound education. Being that wrong, that paralyzed by the market, it burned a lesson into his brain that he would never, ever forget. He knew he had to stop gambling and finally learn how to actually trade. So after losing over and over, borrowing from his mom, his brother, his girlfriend, and just feeling completely tortured, Marcus knew he needed a mentor, a real one. And he found him in a man who would change absolutely everything, Ed Seykota. Now, Ed Seykota was a true genius, a recent MIT grad who was one of the first people to use computers to test and trade market systems. And his core idea was something called trend following. The philosophy is actually pretty simple. You just try to identify which direction a market is moving, and you stay with it. You don't fight it, you don't try to outsmart it, you just ride the wave. Seykota basically drilled these 3 classic trading rules into Marcus's head. Number 1, cut your losses. Number 2, ride your winners. And number 3, follow the trend. Marcus watched Seykota do this with incredible discipline, staying short silver for months while everyone else was bullish simply because the trend was down. These pillars would become the foundation for everything that came next. So, how did he actually start using these new rules? Well, armed with Seykota's wisdom, but still totally broke, Marcus managed to scrape together $700. It wasn't even enough for his own account, so he had to open one with a friend. And then this really weird opportunity popped up during the Nixon-era price freezes. Plywood prices were supposedly frozen at $110, but futures started trading above that price anyway. Marcus jumped in, and in just a few months, his $700 turned into $12,000. And then he made the same old mistake. He bet it all on lumber, thinking the same thing would happen. But the government cracked down, lumber crashed, and his account plummeted to under $4,000. He was right on the verge of getting wiped out again, but this time was different. He held on through 2 weeks of just pure terror, and the market came back. He never bet everything on one idea again. Okay, now we're going to jump forward to 1979. Marcus is now a seasoned, incredibly successful trader working for a firm called Commodities Corporation. One night, he's at home in California just watching TV when a news flash comes across the screen about the invasion of Afghanistan. He knows instantly what this is going to do to the gold market. Now, it's the middle of the night in New York, but the market in Hong Kong is wide open. Marcus gets his broker on the phone there and asks if anyone knows about the invasion. Nobody does. The price is just sitting there, stable. So before pretty much anyone else in the world knew what was happening, he was able to buy 200,000 ounces of gold. That is a massive position, the equivalent of 2,000 futures contracts. About 5 to 10 minutes later, the news breaks wide and everyone starts scrambling to buy gold. He had an instant $10 per ounce profit on that huge position. That is a $2 million gain in minutes. Think about that. From getting wiped out on a fake pork belly trade to this, the transformation was complete. So after seeing this incredible journey from total repeated failure to absolute mastery, what can we take away from it? What are the core hard-won rules that Marcus lives by? Well, his number one rule, the one born directly out of those disasters in corn and lumber, is all about one thing: survival. He says you should never, ever bet more than 5% of your money on any single idea. This way, as he puts it, you can be wrong more than 20 times. It's going to take you a long, long time to lose all your money. And here are the other pillars of his philosophy. You always use a stop-loss order, so you've already committed to an exit point. If you're ever in doubt about a trade, just get out. You can always get back in later with a clear head. Hold on to your winners and cut your losers short. They're equally important. You have to follow your own light. Trying to copy someone else's style never works. And finally, be patient. You wait for those rare moments when everything lines up: the fundamentals, the charts, and the market's overall mood. But in the end, after all the wins and losses and millions of dollars, Marcus's biggest takeaway isn't really about money at all. It's about a quote from Albert Einstein. He says the real goal is to get to a place where you truly feel, deep down, that the universe is a friendly place. He admits he started off feeling like it was a very unfriendly place, but after all this, he's a lot closer. And that's a pretty profound final thought, isn't it? Maybe the real prize in mastering the markets is mastering yourself enough to finally find some peace within them.
All right, we're about to dive into the mind of a true trading ghost, a legend who moved billions of dollars but stayed almost invisible: Bruce Kovner. Now, he's one of the most successful traders in history, but his story doesn't start on Wall Street. Nope, it starts in a Harvard lecture hall. So how on earth does a quiet academic become a titan of the global markets? Let's find out.
Let's just start with a number: $1 million. It's a staggering figure on its own, right? But what makes it truly unbelievable is where it came from.
Yeah, you heard that right. That's not a typo. If you had handed Bruce Kovner just $2,000 back in 1978, by 1988, you'd have over $1 million. That's an 87% average annual compounded return. I mean, to put that into perspective, that is a level of performance that most traders can only dream about. It puts him right up there in the pantheon of investing titans.
But here's the real puzzle. The guy making these billion-dollar bets, he wasn't some aggressive, fast-talking trader. People who met him said he was more like a quiet university professor, really thoughtful, incisive, and just calm. So what's the secret? How does a man with an academic's temperament develop the iron nerve to make some of the biggest wagers in financial history? To answer that, we have to go back to the beginning. See, his journey into finance wasn't a straight line at all. It was a very deliberate and calculated pivot from a completely different world.
So Kovner's first path was actually in academia and politics. He taught political science and even managed campaigns with his eye on running for office himself. But he hit a wall, a lack of funds. So in the mid-70s, he pivots. He realized that the global markets were like this grand chessboard, where his skills in political science and economics could give him a really unique edge. And he didn't just dip his toes in, he dove headfirst, spending a full year in intense study, trying to understand the very heartbeat of the world's economy. And you know what? That deep study paid off, big time. He fell in love with interest rate theory and spotted this inefficiency in the young futures market. His very first trade, a complex spread based on his academic research, worked exactly like the textbooks said it would. And from that moment on, oh yeah, he was hooked. He knew this was his arena.
But Kovner's most important lesson? It didn't come from a victory. Oh no. It came from a trade that went so wrong, so fast, that it seared itself into his brain forever. A trade that started with incredible promise and ended in a near-total psychological collapse. This is the story of the soybean disaster.
So it's early 1977, and after a few small wins, Kovner's account stood at $4,000. It was right then that he spotted what he thought was a massive opportunity. In the soybean market, all the signs were pointing to a shortage. And his analysis was just spot on. The market exploded upwards. As it climbed, he expertly added to his position, pyramiding his profits. By April 12th, that $4,000 account had swelled to an astonishing $35,000. I mean, he was playing the game perfectly.
The very next day, April 13th, the market went into a full-blown frenzy. Soybeans were hitting new record highs, and the trading floor was just electric. At the absolute peak of the mania, his account hit $45,000. Just think about that, from $3,000 to $45,000 in just a few weeks. He was a genius, right? And it was at this exact moment of triumph that disaster struck. His broker, totally swept up in the euphoria, calls him with this fateful piece of advice. See, Kovner was holding a hedged position, which means he had a safety net, a bet that the price might go down to protect his profits. But his broker told him he was a fool to be cautious. He urged Kovner to remove that safety net, to go all in on the idea that soybeans could only go up. It was a direct temptation to abandon the very discipline that had brought him so much success. In a moment Kovner would later call insanity, he actually agreed. He told his broker to lift all of his short positions, leaving him completely exposed and unhedged at the absolute peak of a speculative bubble. It was a purely emotional decision.
Just 15 minutes later, the phone rang again. It was his broker. But this time, he was frantic. The market had violently reversed. It was now limit down. It had fallen so fast and so hard that the exchange had to halt trading. Kovner screamed at him to get out, to sell everything. By the time the smoke cleared, his account, which had touched 45 grand just a little while ago, was now worth only 22,000. He had vaporized nearly half his net worth in the time it takes to drink a cup of coffee.
Okay, now here's where it gets really interesting. What happened next? Most people would focus on the fact that he still churned $3,000 into $22,000, a huge win. But for Kovner, the money was irrelevant. The psychological impact, that's what truly mattered.
Kovner himself called this his going bust trade. He was physically ill, couldn't eat for days. In his mind, he had blown it. His entire career was over. Logically, yeah, he was still way ahead, turning 3 grand into 22. But it didn't feel like a win. It felt like a total failure because he had completely lost control. So here's the key insight. The pain had nothing to do with the money. It was the raw, terrifying discovery that the market can take back everything it gives you in the blink of an eye. It was the shock of seeing his own disciplined, rational mind get hijacked by raw greed and panic. He had thrown his own rules out the window, and that's what truly terrified him.
And this just brilliantly illustrates how a master learns from mistakes. From the ashes of that trade, Kovner forged an ironclad rule that he would follow for the rest of his career. Whenever something happens that disturbs his emotional equilibrium, when his very sense of how the world works is shaken, he gets out. He closes all related positions, period. It's like a circuit breaker for his own psychology. That single, painful experience became the bedrock of his entire trading philosophy. From that moment on, his strategy was built not just on making money, but on surviving his own worst instincts. And this led to the development of what we can call the Kovner Playbook, a set of core principles designed to protect a trader from himself.
So Kovner believes great traders share a few key traits. They are fiercely independent thinkers, able to imagine how the world could be different from how it is today. Crucially, they stay rational under pressure, are willing to be wrong often, and they understand that position size is everything. As he says, a greedy trader, one who trades way too big, always blows out. This is maybe his most famous rule. Before he even enters a trade, he knows exactly where he will get out if he's wrong. The stop loss isn't an afterthought, it's part of the initial plan. He says it's the only way he can sleep at night, knowing his downside is always defined and controlled.
But his philosophy on where to place that stop is just genius. It's not about saying, okay, I'll risk 500 bucks. No. Instead, he asks a different question. At what price point is my original idea for this trade proven wrong? He places his stop there. It's a technical level that, if it gets breached, means his entire thesis is invalid. He doesn't decide he's wrong, he lets the market tell him he's wrong.
So after a legendary career built on these principles, what is Kovner's ultimate advice for anyone trying to navigate the markets? Well, it's remarkably simple, yet profoundly difficult to actually follow. His advice is simple, but it's so powerful. First, risk management is the only thing that matters in the long run. Second, undertrade. He says whatever position size you think is right, cut it in half. Why? Because novices almost always trade 3 to 5 times too big. Third, don't take it personally. The market isn't your enemy, it's completely impersonal. And finally, get rid of hope and wish from your trading vocabulary. They are emotions, not analysis. Focus only on what the market is telling you. Ultimately, Bruce Kovner's story teaches us that market success isn't really about intellect, it's about emotional armor. Trading is a zero-sum game. For you to win, somebody else has to lose. And the real battle, as Kovner learned in that soybean pit, isn't against the market, it's against the greed and panic inside your own head. So the final question isn't just about discipline, it's this. Have you mastered yourself enough to play the game? Welcome to The Explainer. Today, we're diving into the story of Richard Dennis, a true trading legend who made this incredibly audacious bet. And it wasn't just on the markets, but on the very nature of talent itself. It's a story that asks a fundamental question. Are the great traders born, or can they actually be made?
See, at its heart, this whole thing is about a bet. But we're not talking about a single wager. It all started with a simple question, a tiny amount of money, and it would go on to change the world of finance forever. Everything, and I mean everything, begins with this number, $400. Just let that sink in. This was his entire trading stake, which he had to borrow from his family back in 1970. And that was only after he scraped together enough to buy a seat on what was basically a minor league exchange. It's an almost impossibly small amount to start a legend with, right?
And this, well, this is the fortune he would eventually build from that tiny little grub stake. He became one of the most successful and legendary traders in history. His own father, in a classic understatement, just said, let's just say Richie ran that 400 bucks up pretty good. Yeah, you could say that. Okay, let's dive into how he did it.
So, we're going to follow his journey step by step, starting with that first $400 bet. We'll see how his early failures actually forged his ironclad rules, which then led to his great experiment. And along the way, we're going to pull out his playbook for mastering not just the markets, but really the mind of a trader.
First up, let's look at how Dennis even got his start. You know, he didn't come from money or some fancy Wall Street firm. Nope, he started at the absolute bottom, and this period of struggle, it laid the foundation for every single principle he would later teach.
So he started out as a runner, literally making just enough to lose it all on his own small trades. But then, in the summer of 1970, he saw something. The grain markets were all closing at their yearly highs. Trusting his simple rule, go with the trend, he bought a few corn contracts. And wouldn't you know it, the very next Monday, news of a massive corn blight hits, and the market just exploded. That single, insightful trade turned his tiny stake into a real bankroll. It gave him the confidence to quit his philosophy grad program after just 1 week to go trade full-time.
But you know, that early success didn't mean the road was easy. In fact, Dennis had this belief that when you start out, you ought to be as bad a trader as you are ever going to be, because the tuition is cheaper then. And for him, that tuition was paid through some very, very painful losses.
I mean, this was his reality in the beginning. He was stuck in this constant cycle of earning almost nothing as a runner and then losing a ton as a trader. But here's the key. He never saw it as failure. He saw it as an education. Every dollar he lost taught him a lesson he would later use to make millions.
Now, this 3-step rule was born from his single most traumatic day of trading. He made a bad trade and lost about 10% of his capital. Panicked, he reversed his position and lost again.
Then he reversed back and lost a third time, wiping out a full third of his entire capital in a single day. So, the crucial point is this. He realized that when you're destabilized by a big loss, your judgment is shot. The only winning move is to stop, create distance, and protect yourself from compounding the error.
So all these experiences, right, the wins, the really painful losses, they all led Dennis to a pretty radical belief. It sparked this long-running argument with his partner and, well, it set the stage for one of the most famous experiments in financial history.
And this was the fundamental disagreement that just drove him crazy. Was trading some kind of innate talent, an artistic or intuitive gift that you either had or you didn't? Or was it a skill, a craft that could be broken down, codified into a set of rules, and then taught to just about anyone?
His partner was convinced trading was an art. Dennis was absolutely adamant it was a science. For years they argued about it, until Dennis, just fed up with all the talk, decided to settle the argument once and for all with a real-world experiment. He was going to prove his point by manufacturing great traders from scratch.
He'd just gotten back from a trip to Asia where he'd visited a turtle farm, and he saw thousands of these little turtles being raised in a giant vat. That became his guiding image for the whole program. He would find ordinary people and just grow them into elite traders, and his trainees, fittingly, were nicknamed the Turtles. And the sheer audacity of this experiment was matched only by its success. I mean, he took people from all walks of life, a chess player, an accountant, a security guard, gave them a 2-week crash course, and then handed them millions of his own dollars to trade. And the results you see here, they were just astounding. Dennis had proven his point in the most dramatic way possible. It was, in his own words, frightening how well it worked.
Okay, so if trading can be taught, what exactly was Dennis teaching these turtles in that super short 2-week course? Well, it wasn't about complex economic forecasting or some secret formula. It was about a few core principles of discipline, statistics, and psychology.
This simple chart right here reveals one of his most powerful truths. Dennis figured that 95% of his profits came from just 5% of his trades. Think about that for a second. The vast majority of the time, a trader is just breaking even or taking small losses. The entire game, he taught, was preserving your capital and your nerve during that other 95% of the time so that you were ready to pounce when those rare, massive opportunities finally appeared.
And this was the secret ingredient. For Dennis, the rules themselves were simple, often just variations of buy high, sell higher. The real challenge, and the true gift he gave the turtles, was the absolute conviction and confidence to stick to those rules, especially when things were going badly and every instinct in their body was screaming at them to do something else.
His central philosophy was something called trend following. He believed you didn't need to predict anything about the future. Nope. You just had to be disciplined enough to recognize a major trend once it emerged and then ride it for all it was worth. And the system worked in any market, from soybeans to bonds to currencies, because it was based on market behavior, not on the product itself. But, no system is foolproof and no strategy works forever without adapting. In the late 1980s, Dennis faced his greatest professional test, a period of immense, gut-wrenching losses that would have broken most traders and completely shattered their philosophies. His trend-following systems, which had worked so beautifully for years, were suddenly getting whipsawed. Markets would signal the beginning of a strong trend, his systems would buy in, and then prices would just violently reverse. He believed this was because too many computerized traders were now using the same simple strategies, essentially polluting the market signals he relied on. Yet, through all these massive losses, people who interviewed him noted his incredible emotional detachment. His secret? It was perspective. He knew that big losses were an unavoidable part of the game. He actually worked to avoid the emotional high of a big win, because he knew that very same feeling would make him vulnerable to the emotional despair of a big loss. So, shortly after these losses, Dennis famously retired from trading to focus on his political and philanthropic interests. But he left behind a clear and powerful set of principles for anyone who operates in a high-stakes field that's defined by uncertainty. And ultimately, his core advice really boils down to this. It's all about managing yourself, not trying to outsmart the market. Protect your capital when you're new, learn from every single error, and stay disciplined in your process. Because while the outcome of any single trade is random, the one thing you can control is your own behavior. And this is the ultimate question his story leaves us with. Through the turtle experiment, he proved that the knowledge needed for huge success can be transferred.
The rules can be written down and taught in 2 weeks. But the real battle isn't with the market. It's against our own fear, our own greed, and our own impatience. And that is the Dennis legacy.
All right, let's unpack the mind of a true Wall Street legend, Paul Tudor Jones. This guy is a maverick, and his aggressive, almost counterintuitive style has amazed and, baffled the financial world for decades. And the numbers he's put up, honestly, they're kind of hard to believe. So, picture this. It's October 1987. The financial world is in a complete and total tailspin. And the Tudor Futures Fund, which Jones is running, posts a staggering 62% return. And get this, that's not for the year. That's in one single, absolutely chaotic month.
Now you might think, okay, maybe it was just a huge bull market. Nope, not even close. We are talking about Black Monday. The world's stock markets were in an absolute freefall, a collapse so bad people were comparing it to 1929. Most investors were getting wiped out left and right, but Jones, he was thriving.
So that's the big question, right? How on earth does one guy stare into the abyss of a total market collapse and not just survive, but actually turn it into his greatest victory? Well, the answer has nothing to do with luck. It's an incredible story of failure, discipline, and a complete reinvention of his entire approach to the markets.
So here's our game plan for this explainer. We'll start with his meteoric rise, then look at the catastrophic trade that almost ended it all. From there, we'll see how that failure helped him forge a new set of defensive rules, how he learned to read the market's mind, and what his legacy is beyond just trading. And finally, we'll boil it all down to a single most important lesson.
First up, the maverick of Wall Street. You see, even before that insane 1987 performance, Jones had already built a reputation for unconventional and just staggering success.
I mean, his rise was just incredibly fast. He gets started in '76 with a legendary mentor, and by his second year as a broker, boom, he's already grossing over $1 million in commissions. He goes independent in 1980 and has just one losing month in almost 4 years. Then he launches his own fund in '84 with only $1.5 million, and 4 years later, it's managing $330 million. Yeah, this wasn't a slow and steady climb. This was a straight-up rocket ship. So where did this relentless drive come from? Well, a huge piece of it was forged under his first mentor, the legendary cotton trader Eli Tullis. Jones said Tullis taught him that trading is brutal, it's competitive, and you better be able to take a punch. It was a lesson in mental toughness that, man, would prove essential later on.
But all this early success was building towards a single, pivotal moment, a near-total disaster that would ultimately define him. We're talking about the 1979 cotton market trade.
He was young, he was successful, he was feeling confident, probably a little too confident. And standing outside the trading ring, in what he later called an act of pure bravado, he put in a huge bid on July cotton. He described it himself as a macho-type bid, you know, the kind of move you make when you think you just can't lose. The second that order was filled, he knew. He knew he'd made a catastrophic mistake. He said he saw instantly that the market was headed straight down, and that his massive position was the fuel for the fire. It was his blood, as he put it, that was going to carry it there. Just a gut-wrenching realization.
And the consequences were absolutely devastating. His accounts lost between 60 and 70% of their value, not over a bad quarter, not over a bad month, but from a single trade. His own ego had brought him to the very edge of being completely wiped out.
He was completely demoralized, so much so that he nearly quit the business for good. But this moment of failure became his turning point. He called it a cathartic experience. He went to the absolute edge, questioned everything about himself, and made a decision. He wasn't going to quit. He was going to come back, but he was going to be completely different.
And this leads us to the rebirth of his trading style. You see, from the ashes of that one terrible trade, he forged an entirely new philosophy, one that wasn't built on aggression, but on defense.
The shift in his thinking was just profound. Before that crash, his whole focus was on offense. How much money can I make? He was playing macho man with the market. After, everything flipped. His focus became defense. How much could I possibly lose? He stopped dreaming about the upside and started obsessing over his maximum possible loss on any given day.
In this new philosophy, it wasn't just some vague idea. It became a set of hard and fast rules. Play great defense, not great offense, became his new mantra. He swore he would never average down on a losing trade again. He started every trade assuming he was wrong. If he was trading badly, he'd immediately cut his size. If a trade just felt wrong in his gut, he got out, no questions asked. And the biggest rule of all, don't be a hero. Don't have an ego. The market will always, always humble you.
Okay, so with this ironclad defense now in place, how did he play offense? Well, this is where we see his genius as a contrarian opportunist, especially in his unique ability to spot market turning points.
Now this really flies in the face of conventional wisdom. Most traders, they're taught to follow the trend, that trying to pick tops and bottoms is a surefire way to get killed. But Jones believed the exact opposite. He was convinced the very best money was made at these turning points, and he basically built his career on being able to nail them.
So how did he do it? It wasn't guesswork, it was a disciplined process. First, he'd develop a strong, long-term view of the market. Then he'd test that idea with a bunch of small, low-risk probe trades. He used incredibly tight stops, not just on price, but on time. If the market didn't react how he expected within a certain time frame, he was out, even if he wasn't losing money. If he kept getting stopped out, he'd just reduce his position size and keep probing until the market either proved him right or he decided he was wrong.
But Jones's story doesn't just end with the markets. The success he found there allowed him to build a really powerful legacy in a whole other area, philanthropy, all of it driven by a deeply personal philosophy.
He actually called philanthropy his second avocation. He founded the now famous Robin Hood Foundation, which funnels money to frontline poverty-fighting groups. He also started his own I Have a Dream program, personally funding the college education for 85 students and, get this, meeting with them every single week. He was driven by this powerful idea he called the multiplicative impact, the belief that helping one person can create this ripple effect that lifts up an entire family and their community.
So, let's bring this all together. After decades of incredible success and one nearly career-ending failure, what's the single most important lesson? What's his single most important rule?
When you ask him for his single most important piece of advice for the average trader, his answer isn't some complex strategy or a secret formula. It's something way more fundamental.
This is it. This is the core of his entire philosophy, forged in the fire of that 1979 cotton trade. Don't focus on making money. Focus on protecting what you have. It's the ultimate expression of playing great defense. Your first job isn't to get rich. It's just to stay in the game.
And that is the ultimate takeaway from the incredible career of Paul Tudor Jones. It completely reframes what it means to be a successful trader. It's not about how brilliantly you attack the market or how much you can make on your best day. It's all about the resilience of your defense, how well you manage your risk, and how you survive your worst day so you can trade again tomorrow.
All right, get this. Imagine a single trader working out of some small office in Peoria, Illinois, who quietly becomes one of the biggest, most dominant forces in the entire global financial system. Well, today, we're diving into the incredible and kind of secretive story of Gary Bielfeldt. This is the guy who took on Wall Street's titans and won.
So let me just ask you something. When you think about the T-bond market, literally the largest futures market on the planet, who do you picture as the biggest players?
I bet you're thinking of these massive Wall Street firms, right? Huge corporations with armies of analysts and just billions and billions of dollars in capital. And yet, for the most part, that's a pretty accurate picture. But what if I told you that for years, one of the most powerful forces in that entire market was known only by 3 initials, BLH? And here's the kicker. BLH wasn't some huge corporation. It was one guy, one person, Gary Bielfeldt, trading from his office in Peoria. So how on earth did he pull that off? Let's get into it. Okay, so his story starts with a challenge that seems, almost impossible today. Trying to forge a career as a professional trader with a stake that would barely even cover a month's rent. Bielfeldt literally started with just $1,000. That's it. His capital was so tight that he could only afford to trade a single corn contract at a time. And he was doing this part-time, mind you, while running a small brokerage office just to make a living. I mean, talk about starting from scratch. But through sheer discipline, grinding it out, by 1965, he had painstakingly managed to build that initial grand up to $10,000. And this wasn't just profit to spend, oh no. This was the seed money. This was the stake for a move that was going to define his entire life. You see, he desperately wanted to trade full-time, and he thought he saw his big chance in the soybean market. He got this incredibly strong conviction that prices were about to shoot up. So he decided to make a massive, and frankly, a pretty reckless, all-or-nothing bet. He put his entire 10 grand on the line to buy 20 soybean contracts. Now, just to give you some perspective on how crazy this was, his position was so leveraged that if the price of soybeans dropped by just 10 cents, he would have been completely wiped out. Game over. And of course, at first the market went against him. He came so close to getting that dreaded margin call, the call that would have ended his career right then and there, but he held his nerve, he didn't panic, and then the market turned. It reversed. By the time he cashed out, he had more than doubled his entire stake on that one single trade. That was it. That was the bet that launched his dream. But here's the thing. His incredible success in the grain markets actually created a whole new, unexpected problem. He was getting too big for the game he was playing, and it forced a pivot that would lead to his biggest wins ever. So after that career-making trade back in '65, Bielefeld's account just grew and grew. So much so that by the early '80s, he was actually bumping up against government position limits in grains. He literally wasn't allowed to trade any bigger. So that, plus a really painful loss he took in soybeans in 1983, made him realize he had to find a new playground. And he found it in T-bond futures, a much, much bigger arena with a position limit of 10,000 contracts. And it's funny, that huge soybean loss in '83, it might have been the best thing that ever happened to him because it pushed him out of his comfort zone and set him up perfectly for what would become the trade of a lifetime. I mean, the timing was just unbelievable. Right as Bielefeld is turning his attention to Treasury bonds, the T-bond market itself was quietly forming a major historic bottom. It was like he walked into a brand new stadium just as the Super Bowl was about to kick off. In his conviction, it wasn't just some gut feeling. It was based on what he was seeing with his own two eyes. He said, "I felt that interest rates had probably gone high enough." Back in his hometown of Peoria, unemployment was hitting almost 20%. The farm crisis was just destroying the local community. And yet government interest rates were sky high. He saw that disconnect, that fundamental clash, and he made his bet. Rates had to come down, which meant bond prices had to go up. But look, getting the timing right is one thing. The really incredible part, the thing that separates the legends from everyone else, was his discipline to just sit there and hold that winning position for almost 2 full years. That patience, that long-term conviction, that's what allowed him to ride that massive trend and catapult himself into the same league as the biggest institutions on Wall Street.
So, you gotta be asking, what was the philosophy? What was the mindset that let him make such a disciplined, high-stakes trade? Well, it all boiled down to a really simple but powerful analogy his father taught him.
Let's just hear it from the man himself. "I have always tried to keep the concept of patience in mind by waiting for the right trade, just like you wait for the percentaging hand in poker. That one simple idea, that was everything. That was the core of his whole strategy." And the comparison is just perfect, right? Think about it. In poker, you fold your bad hands. You only lose your small ante. In trading, you get out of a bad trade with a small, manageable loss. But when you get a great hand in poker, a high percentage hand, you bet big. You press your advantage. It's the same thing in trading. When a trade is really working, when the odds are stacked in your favor, you get aggressive. And that simple, profound discipline of taking small, painless losses so you can cash in on the huge wins, well, that's what separates the pros from everybody else. So he basically boiled it all down to 5 key traits. First, you need the discipline to actually stick to your plan. Then, the patience to wait for the absolute right moment. That takes courage, which he said really comes from having enough capital so you're not trading scared. And this is a big one. You need a willingness to lose, to be okay with taking a small hit without getting emotional. And finally, driving it all, you need a deep, powerful desire to win. But here's the most interesting part of the story, I think. For Gary Bielefeld, winning in the markets was never really the point. It was just a means to an end. His real definition of success had almost nothing to do with his account balance. He said it as simply as you possibly can. "I judge success by what I do with the money I accumulate." I mean, that just reframes the whole thing, doesn't it? It's not about profit, it's about purpose. And he wasn't just talking, he lived by that. In 1985, right at the peak of his trading success, he and his wife started a foundation to give back to their community in Peoria. And he said this wasn't some new idea he had after getting rich. No, it was a goal he'd had since the 1970s. It was one of the things that motivated him all along. Which really just leaves us with one last question to think about. Here's a guy who made one of the greatest trades in history, but his story kind of forces you to ask, what does profit really mean? Maybe the ultimate return on a trade isn't measured in dollars and cents, but in the legacy you can build with it. It really makes you wonder, what is the real measure of a winning trade? You know, in the world of trading, you have the legends everybody's heard of, and then you have the masters who kind of operate in the shadows, the ones the legends themselves look up to. Today, we're going to pull back the curtain on the mind of one of those masters, a man named Ed Seykota. 250,000%. Just look at that number. I mean, what does that even mean? It's not a typo. This was the actual cash-on-cash return of a single client account that Ed Seykota managed. It started with just $5,000 in 1972, and by 1988, it had grown by over 250,000%. A track record so wild, it almost sounds made up. So, who is the guy behind this mythical number? Well, when another legendary trader, Michael Marcus, was asked about his biggest influence, he named Seykota. And he said something really interesting. He said he's not just a great trader, he is a mind. That one word, that tells you everything you need to know. Seykota's approach goes way beyond charts and numbers. It's a whole philosophy on markets, on psychology, and really on life itself. And Seykota's genius was matched only by how unconventional he was. I mean, picture this. He wasn't trading from some chaotic Wall Street floor. He worked from a quiet office in his home on Lake Tahoe. And forget about all those flashing quote screens and a constant stream of news. He ran his entire system in just a few minutes a day. And the rest of the time, well, that was for thinking. But to really get his unique approach, we have to go back to the beginning. See, Seykota wasn't just using trading systems. He was one of the very first people to actually invent them for managing money. We're talking about a true pioneer turning these abstract ideas into real profits using the, get this, punch card technology of the day. His path to becoming this independent wizard was really forged in frustration. It all started in the late 60s, when he learned this huge lesson trading silver, that the most obvious news is almost always already baked into the price. Then, by the early 70s, he's at a major firm where management is censoring his analysis and blocking his computer access. So what does he do? On weekends, he becomes this renegade, secretly using the company's giant IBM 360 mainframe to test his theories on punch cards. The results just confirmed what he suspected about trend following. And right then, he knew. He had to break free. And that breaking point, it came down to a single trade. While he was still at that brokerage firm, his brand new system just lights up. It spits out this crystal clear buy signal for sugar at just 5 cents a pound. His research told him this was the start of a massive move. I mean, the perfect test for his entire approach. But there was one big problem: management. They got in the way. They let their emotions completely override the system. They thought the market was overbought and just refused to take the signal. So as sugar kept climbing, they chased it, finally buying near the top, and then, to make it even worse, they ignored the sell signal on the way down. The results? What should have been the most profitable trade of the year actually turned into a loss. For Seykota, the lesson was painfully clear. He had to be on his own to follow the system without anyone's emotional interference. So once he went independent, Seykota was finally free to trade purely based on his system and his philosophy. And over decades of just incredible success, he boiled down his wisdom into a set of core principles. And these aren't just tips, okay? These are the ironclad rules for survival and, well, prosperity in the markets. When somebody asks him for the elements of good trading, Seykota's answer was just brutally simple. Rule number 1, cut your losses. Rule number 2, cut your losses. And rule number 3, cut your losses. He says it 3 times for a reason. It is the absolute non-negotiable foundation of everything. Without that, nothing else you do matters. His other rules build right on top of that foundation. Ride your winners. Keep your bets small. Never, ever risk more than 5% on a single trade. And then we get to this fascinating contradiction. Rule 5 is, follow the rules without question. And rule 6 is, know when to break the rules. Wait a minute. How can both of those be true? This is what I like to call the trader's paradox, and it's totally central to Seykota's genius. See, following the rules, that gives you the discipline to survive. It keeps your emotions from blowing you up. But, and this is the key, he argues that a trader has to evolve. You can't just follow someone else's rules forever. You have to find or build a system that truly reflects your own style. Breaking a rule is how you discover a new rule that might work even better for you. It's a constant process of growth. And this whole idea of personal evolution, well, it brings us to what Seykota considers the most important element of all. He famously said that market analysis is the roadmap, but psychology is the driver. Think about that. You can have the best map in the world, but if the driver is drunk on fear or greed, you're going to end up in a ditch. His view on this internal game is perfectly captured by his famous warning about emotional banana peels. Pride, hope, fear, and greed, these aren't just feelings. They are active dangers waiting to trip you up. Seykota admitted his own biggest mistakes always happened right after he got emotionally wrapped up in a trade. Okay, so if he wasn't driven by emotion or news, which, by the way, he hilariously called funny mentals, what did he actually focus on? His priority list was super simple. Number 1, the most important thing, the long-term trend. Number 2, the current chart pattern. And number 3, picking a good entry point. And way, way down at the bottom of the list, fundamental ideas. In his mind, by the time we read the news, it's already in the price. So what kind of personality actually succeeds with this kind of approach? Seykota had a simple two-part definition. First, he said, you have to truly love to trade. It's got to be a real passion. And second, you have to love to win. Now, that second part sounds obvious, right? Of course you love to win. But understanding what he really means by that, well, that's the key to his entire philosophy. And that right there brings us to the most provocative, the most challenging, and honestly, the most powerful concept Seykota ever shared. It's a single sentence that, if you really let it sink in, can change how you view not just the markets, but all of human behavior. Let's just let that sit there for a second. Win or lose, everybody gets what they want out of the market. At first, that sounds completely absurd. It implies that losing traders somehow want to lose. The people who fail are actually fulfilling some kind of hidden desire. But Seykota was dead serious about this. To explain this, he told the story of a trader he knew. This guy had an almost uncanny ability to catch the start of every big move. He would take a $10,000 account and, like clockwork, he'd run it up to $250,000. But then something would change. His whole personality would shift, and he would give it all back. Every single time. So you have to ask, what was this trader really getting out of the market? Was his goal to make money? Seykota would argue no. His real subconscious desire was for the psychological payoff of the cycle itself. He got the excitement of the wild ride up. He got the martyrdom of the collapse. He got the sympathy from his friends. He got to be the center of attention. He got the comfort of returning to a financial state that was familiar to him. On a deep, subconscious level, he was winning by losing. He was getting exactly what he wanted. And this is where Seykota's philosophy goes way beyond trading and becomes the question for all of us. He believed our results in any part of life perfectly reflect our deepest priorities, whether we admit them to ourselves or not. So his ultimate challenge is simple, and it is profound. What do you really want? Because win or lose, that's what you're going to get. Today, we're going to dive into the mind of a true market legend, Larry Hite. Now, he's a pioneering fund manager who built an absolute powerhouse, but his journey to the top of Wall Street, well, it was anything but ordinary. In fact, it's one of the most unconventional success stories you'll ever hear, and it all boils down to one simple idea: respecting risk. So before he was managing nearly $1 billion, Larry Hite's resume was eclectic, to say the least. He started out as an actor and a screenwriter, paying the bills with a movie script he kept optioning. Then he completely pivots and becomes a rock promoter, trying to get those huge returns on a tiny investment. But after 3 separate shootings at his clubs, he learned a very real, very visceral lesson about unpredictable, catastrophic events, what traders call tail risk. This wild path gave him a perspective on risk that was just totally alien to the traditional world of finance he was about to walk into. All right, so here's how we're going to break down his genius. First, we'll look at his completely unlikely path into trading. Then, we'll get into the blue chip epiphany that changed everything for him. We'll see how he built his legendary fund, Mint, and then we're going to dissect his 4 core rules for survival. After that, we'll learn from the failures he saw firsthand, and finally, boil it all down to the 2 simple rules he lives by to win. So let's start with the man himself, the unlikely trader. Hissey was always drawn to the markets, but he was a total outsider. He didn't have that typical Wall Street background, which meant he had to find a completely different way to break in. This quote just says it all, doesn't it? Most people on Wall Street are dreaming of running off to become screenwriters. His White was a screenwriter desperately trying to get to Wall Street. He was hustling in these creative fields just to fund his real passion for the markets. And that right there, that shows a level of dedication and an outsider's point of view that would end up being his biggest weapon. Okay, so every great trader has that one moment where it all just clicks. For Larry Hite, that moment happened, of all places, during a job interview. And it would define his entire approach to the markets forever. So, picture this. Hite's in his first interview at a super traditional, old-school Wall Street firm. He said the place just made you want to whisper. And the interviewer, a guy Hite says talked with his teeth clenched together, says very plainly, "We only buy blue chips for our clients." Now Hite, coming from outside of finance, had no idea what that meant. It just sounded weird, especially for a supposedly conservative firm. So, after the interview, he did what any of us would do. He went and looked it up. And what he found was incredible. The very term that Wall Street uses to describe its safest, most reliable stocks, it comes directly from the world of high-stakes gambling in Monte Carlo. For Hite, this wasn't just a fun piece of trivia. It was a complete and total revelation. And there it is, the light bulb moment. He literally went home, threw away his copy of Graham and Dodd, the supposed Bible of investing, and bought a book called Beat the Dealer. He realized that being a successful investor wasn't about pretending you could predict the future or being an expert on some company. No, it was about understanding the odds, managing your risk, and making statistically smart bets, just like a professional card player. So, armed with this massive insight, Hite didn't just want to trade. He wanted to build something new. A trading firm that ran on rigorous scientific testing, not gut feelings or hot tips. He wanted to build a literal money-making machine. And Hite knew he couldn't do it alone. He was the ideas guy, the visionary, but he needed to prove his ideas were statistically sound. So he brought in Peter Matthews, a PhD in statistics, to handle the math. Then he hired Michael Dellman, a computer systems whiz, to build the actual trading infrastructure. Hite is adamant that without them, Mint never would have happened. And the results? They were just staggering. Look at this consistency. Mint's goal was never to have the highest return in 1 year. That wasn't the game. Hillett wanted the best growth rate he could get while keeping risk on an extremely tight leash. Their worst year was a 13% gain. Their best was 60%. This wasn't about swinging for the fences. It was about getting on base every single time. And it turns out, this disciplined, risk-first approach was exactly what investors were looking for. The firm started with just $2 million in 1981. By the middle of 1988, they were managing over $800 million. That explosive growth just proved that Hite's philosophy wasn't some abstract theory. It was a scalable, powerful engine for making money. So, what was the secret sauce? How did they actually achieve that kind of consistency? It all came down to a set of non-negotiable rules for controlling risk. These were the core principles that drove every single decision at Mint. These were the 4 pillars of their survival. First, you always followed the trend. They had a rule. No one, not even Hite, could ever override a signal from the system. Emotion was out. Second, and this one is huge, they strictly limited the size of every single bet. Third, they diversified like crazy. I'm talking nearly 60 different markets and multiple systems to make sure no single bad event could ever sink them. And fourth, they constantly tracked volatility. If a market started swinging too wildly, becoming too unpredictable, they just got out. Simple as that. And this number, this is the key to the whole thing. The most important rule they had was to never risk more than 1% of their total equity on a single trade. Think about that. It made the outcome of any one bet almost irrelevant. A single loss could never seriously hurt them. This is the absolute essence of survival in the markets. That 1% rule let him focus on making good bets, not just winning bets. This is such a critical distinction. Most people think if a trade loses money, it was a bad bet. That's totally wrong. A good bet is one where the odds and the potential payoff are in your favor before you even place it. Even if you lose that one time, it was still the right decision. If you just keep making good bets over and over, you mathematically have to come out ahead. It's a numbers game. Now, to really understand the power of these rules, Hittei often tells stories about people who learned about risk the hard way. These are the cautionary tales, the traders who thought they were smarter than the market itself.
So Hyatt was at dinner once with one of the world's biggest coffee traders. And this guy was just baffled by Hyatt's approach. He kept asking, "Larry, how can you possibly know more about coffee than me?" Hyatt's answer was simple. "I just look at the risk." 5 times the guy asked, and 5 times Hyatt gave him the exact same answer. And the punchline? 3 months later, that same expert coffee trader lost $100 million. As Haidt puts it, he does know more about coffee than I do, but the point is, he didn't look at the risk. Being an expert is useless if you don't manage your risk. It's a recipe for disaster. Here's another tragic one. A good friend of Haidt's, who he calls Beverly, had a profitable trading system he developed. But one day, he got a sell signal in gold, and he just decided to ignore it. His gut told him it was wrong. He didn't just ignore the signal, he went long. The market tanked, and because he stubbornly refused to get out, he lost everything. A mansion, a fortune, all of it gone on a single trade he never should have been in. So, after decades of trading, of testing, of watching incredible success and just catastrophic failure, Larry Haidt boiled his entire philosophy down to 2 incredibly simple but really profound rules. And here they are. It's just a beautiful, perfect balance. Rule 1 says you have to take risks. You've got to be in the game to even have a chance of winning. But Rule 2 is the foundation for everything else. Survival is the most important thing. Protecting your capital, your chips, is your #1 job, because without them, you can't make any more bets, game over. And really, that brings us to the final thought here. Haidt's philosophy goes way beyond the trading floor. We are all managing risk, every single day, in our careers, our money, our relationships. So the question I want to leave you with is this. In your life, what are your chips? Your time, your money, your health, your reputation? And are you respecting the risk? Are you making good bets?
You know, on Wall Street, you've got your legends, and then you have figures who just seem to be playing a totally different game. Michael Steinhardt is one of those guys. Incredibly demanding, super intense, and just relentlessly successful. And today, we're going to pull back the curtain on the one core philosophy that powered one of the greatest track records the market has ever seen.
Okay, let's just start with this number, 24.5%. I mean, it's almost hard to wrap your head around. For 21 straight years, from 1967 all the way to 1988, Steinhardt's firm delivered a compounded annual growth rate of 24.5%, and that's after taking out his massive 20% performance fee. It's just a truly staggering figure that puts him in the absolute top tier of investors, period.
And this chart, man, it just perfectly shows you what that percentage really means for your money. If you'd put $1,000 in the S&P 500, you'd have ended up with a respectable $6,400. Not bad. But that same $1,000 with Steinhardt, it would have turned into over $93,000. That's not just beating the market, that's playing a completely different sport.
So, the big question is, how on earth did he do it? Well, that's exactly what we're going to break down here. We'll start by digging into the legend himself. Then we'll unpack his core concept, which he called variant perception. We'll see how that idea holds up under extreme pressure, understand what it means to be a true contrarian, and then wrap it all up with a hard-won wisdom he shared from a lifetime in the markets.
Okay, so first things first, you really got to understand the man behind these insane numbers. Steinhardt was famous for his extreme scrutiny and absolute control. One journalist even nicknamed him Captain Ahab because his desk was shaped like the bow of a ship, and he had this obsessive, all-consuming hunt for profits.
And get this, his journey started super early. He got some stock for his bar mitzvahs, and that lit a fire under him. As a teen, he was hanging out at brokerage offices watching the ticker tape instead of, playing stickball like a normal kid. The guy was a prodigy, graduating from the Wharton School at just 19 years old and launching his own firm by 1967. He was ready to go.
But here's the thing. Those huge returns, that's only half the story. What makes his record so legendary is the consistency. Think about it. In 21 years, only 2 losing years. And in those years, the loss was tiny, less than 2%. And how did he do it? Through just extreme flexibility. See, he wasn't just a stock picker. He was a trader, he was a long-term investor, he shorted stocks, he bought treasury bonds, he would do whatever he thought was the single best bet at that moment.
All right, so this all begs the question, right? What was the intellectual framework that let him be so flexible and so dang successful? And it wasn't some kind of magic formula or black box. It all came down to a single, really powerful idea that he developed.
And here it is in his own words. This is the absolute bedrock of his entire philosophy. He even gave it a name, variant perception. Sounds simple enough, right? But actually doing it? Well, that's a whole different story.
Okay, so the most crucial thing to get here is that variant perception is not about just being a contrarian for the heck of it. It's not about just blindly betting against what everyone else is doing. No, it's a disciplined process of doing deep, hard, rigorous analysis to form a view that you believe is not only different from what the market thinks, but is also more correct.
So, think of it like this. On one side, you've got the consensus view. That's the common story, the narrative everyone accepts. It's what's already baked into the stock's price. But on the other side, you have your variant view. That's the hidden reality, the thing the crowd has totally missed. And the profit, the whole opportunity, it lives right there in the gap between those two. Your entire job is to find that gap.
Yeah, having a theory is the easy part, right? But what happens when you actually put your money where your mouth is and the entire market starts screaming that you're dead wrong? That's the crucible. That's when variant perception gets truly tested. Let's look at a couple of legendary examples.
Let's take his legendary short of Genentech. The consensus view was, this is a revolutionary company. It's going to change the world. But Steinhardt's research led him to a totally different conclusion. His variant view was that their main drug was way overhyped and would soon be replaced. So he shorted the stock. And for months, he lost a ton of money as all this enthusiasm kept pushing the stock higher. But because his core research hadn't changed, he held on. And guess what? The stock eventually collapsed from over $65 a share to under $15.
But an even more intense test was his bet against rising interest rates back in 1981. His view was that rates had to fall, so he took a huge leveraged position in treasury bonds. The only problem? He was early. For months, rates just kept climbing, and the losses were piling up. He even called it the worst experience of my business life. But he didn't flinch. He never liquidated. And when rates finally did turn, the profits were just absolutely enormous.
And you got to understand, the pain wasn't just about the money. Here he was, an equity guy, making this massive contrarian bet in the bond market. His own investors were getting nervous, questioning his expertise, and putting him under immense psychological pressure. But his conviction, which was totally rooted in his variant perception, allowed him to see it all the way through.
So what these stories really show is a super important point. Being a successful contrarian isn't just about waking up one day and deciding to bet against the herd. It's way more than that. It's a complex art form.
I mean, Steinhardt himself will tell you, that whole cliche, the crowd is always wrong, it's a really dangerous way to think. He pointed out that tons of other contrarians got absolutely destroyed betting against rising interest rates. They bought bonds when yields were at 8%, then 9%, then 10%, and they got wiped out long before the final peak.
So what separates the winning contrarians from the ones who get wiped out? Well, Steinhardt says it's this incredibly delicate balance. You have to get the timing right, you need the right position size, not so small that it doesn't matter, but not so big that a bad move takes you out of the game. And maybe most important of all, you have to have the guts, the psychological strength to handle the intense pain of being early.
You know, Steinhardt's contrarian streak, it didn't stop with his market calls. It went all the way down to the very mechanics of trading. He was also deeply skeptical of all the so-called rules of trading you hear about all the time.
I mean, just think about all the standard trading advice you always hear. Buy on breakouts. Always use a stop loss. Draw these trend lines on charts. So for Steinhardt, were these things actually useful? His answer was a huge, almost dismissive no.
And this quote, man, it just perfectly captures his total dismissal of technical analysis. Charts did nothing for him. To him, they were just a bunch of squiggly lines without any real substance, a total distraction from the deep fundamental work that he based all his ideas on. That blah, 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 yeah, that pretty much says it all.
So his list of what not to do, it basically reads like a direct attack on every trading textbook out there. No stop losses, no price targets. And his logic was really powerful. If you've made a mistake, you deal with the mistake directly. You sell the position. Don't try to fix it by adding a hedge, because then you just have two problems instead of one. For him, these rules were just mental crutches that got in the way of clear, fundamental thinking.
All right, so after this absolutely legendary career,
What's the ultimate takeaway from this market wizard? It's not some simple checklist. It's a really profound way of thinking about the market.
So in the end, Steinhardt saw good trading as this kind of paradox. You have to have the incredible conviction to hold a position like that Genentech short, but you also need the flexibility and the humility to admit when you're just plain wrong. It demands total intellectual honesty and a deep respect for the market. Every single time you buy a stock, somebody else is selling it to you. He was obsessed with asking, why are they selling? What do they think they know that I've missed? And that right there, that leaves us with the ultimate challenge of variant perception. Before you ever put a single dollar at risk, Steinhardt's entire philosophy demands that you answer this one brutally honest question. The people on the other side of your trade are pros. They've devoted their entire lives to this business. So what's your edge? What is your variant perception? And if you can't answer that question, you really have no business being in the game.
You know, what if you could consistently spot the next big thing, the next Tesla or the next Amazon, way before anyone else? Well, that was the entire life's work of William O'Neill. He was a real Wall Street maverick who basically turned investing from a game of hunches and guesswork into a science. He didn't care about hot tips or gut feelings. No, he built a data-driven machine for finding those once-in-a-lifetime stocks. So today, we're going to crack open his playbook. And this, right here, this quote is really the heart of O'Neill's whole philosophy. It's not about blind luck, not at all. It's about this deep-seated belief that if you have the right strategy and you put in the work, you really can turn a small investment into a life-changing fortune. And you know what? He didn't just preach this stuff, he actually lived it. So why should you care about his system? Well, because of this number. 40%. That was his average annual return over an entire decade. I mean, think about that for a second. The average stock market return is somewhere around 10%. O'Neill was quadrupling the market year after year after year. That isn't luck, my friends. That is a system. And we're about to show you exactly how it works. Okay, so here's the game plan. We're going to break his whole method down into 5 key parts. First, we'll get to know the man himself. Then, we'll dig into the one huge discovery that honestly changed investing forever. After that, we'll decode his incredibly powerful CANSLIM system letter by letter. Then we'll cover his ironclad rules for protecting your money. And finally, we'll just bust some of those old Wall Street myths that he proved were costing people a ton of money. See, O'Neill wasn't some Wall Street insider born with a silver spoon. He was a completely self-made guy from Oklahoma who started with basically nothing right in the middle of the Great Depression. As a young stockbroker, he didn't have access to the old boys club, so he had to rely on one thing and one thing only, hard data. And that data, well, that's what helped him turn just $5,000 into $200,000 in only a few years. His rise was, it was meteoric. He goes from being a junior broker in '58 to a multimillionaire by '63. A year after that, he's got his own firm with a seat on the New York Stock Exchange. But maybe the most revolutionary thing he did was launch Investors Daily back in '83. See, he wanted to give everyday folks like you and me the same powerful data that the big dogs on Wall Street had, effectively leveling the playing field for everyone. But what was the secret sauce? What was behind his incredible success? Well, it all boiled down to one single groundbreaking discovery. An insight so powerful and so completely counterintuitive that it shattered like 100 years of Wall Street dogma. O'Neill was basically a data detective. Back in 1959, he managed to get his hands on the trading records for the Dreyfus Fund, which at the time was the hottest mutual fund in the country. He then spent countless hours, all by hand, charting every single stock they bought. He was looking for a pattern, right? Some common thread that connected all of their biggest winners. He was literally reverse engineering success. And here's what he found. You know the old saying, buy low, sell high? Find some beaten down stock that looks like a bargain and just wait for it to recover. Well, O'Neill's data told him to do the exact opposite. Every single home run stock the Dreyfus Fund bought, every single one, was purchased as it was hitting a new high. His revolutionary insight was that strength creates more strength. Stocks that are already winning tend to just keep on winning. So this discovery was the key that unlocked everything. O'Neill then spent years and years studying all the biggest stock market winners in history, looking for their shared DNA. And he boiled all of it down into this powerful 7-step checklist he called CANSLIM. You can think of it like a quality control system for stocks, designed to just weed out all the mediocre ones and identify the true superstars. All right, so this is it, the CANSLIM framework. Each letter stands for a very specific, non-negotiable trait that a stock absolutely has to have before you even consider it. This system is so tough that at any given time, fewer than 2% of all stocks on the market will actually pass the test. Let's break it down letter by letter. Okay, C is for current quarterly earnings. For O'Neill, it was simple. He just couldn't understand why anyone would buy a stock in a company whose profits were flat or even falling. His logic was just brutally simple. If a company isn't making more money right now than it was a year ago, why in the world would its stock price go up? He wanted to see explosive recent growth, period. And he was incredibly specific about what explosive really meant. He wasn't interested in a little 5 or 10% increase. Nope. His research showed that the real market leaders, the huge winners, showed a year-over-year earnings jump of at least 20%, and ideally more like 50% or higher. This is the first and maybe one of the most important hurdles a stochastic sees. Next up, A is for annual earnings growth. See, a single great quarter is promising, but hey, it could be a one-hit wonder, right? O'Neill wanted to see a sustained history of success. He looked for companies that had grown their earnings by an average of at least 24% a year for the last 5 years. It's that combination of a great long-term track record and a recent burst in growth that really signals a superstar in the making. All right, next is N for new. O'Neill found that these massive stock runs are almost always kicked off by something new. A groundbreaking product like the first iPhone, a disruptive new business model. Think about what Netflix did to video stores. Or maybe even new, dynamic leadership that just completely revitalizes a company. And, just as important, N also stands for new highs, which reinforces his core idea that you should be buying stocks as they're hitting new price levels. The S stands for supply and demand. It's basic economics, really. Think of it like a limited edition pair of sneakers. If there are millions of pairs out there, the price pretty much stays stable. But if there are only a few thousand and everybody wants them, the price just goes through the roof. O'Neill found the exact same thing is true for stocks. The biggest winners tend to be companies with a smaller number of shares available. So when the big investors start buying, that limited supply can force the price to go up dramatically. L stands for leader or laggard. O'Neill believed in betting on the fastest horse in the race. He came up with a metric called relative strength, or RS, which ranks every single stock based on its price performance over the last year. So a stock with an RS rating of 80 has outperformed 80% of all other stocks. O'Neill's rule was simple. Only buy these market leaders, the top 20% of performers. Next is I for institutional sponsorship. Look, for a stock to make a huge price move, it needs the buying power of the big guys, mutual funds, pension funds, that kind of thing. So you want to see a few top-quality institutions owning the stock. But, and this is a big but, if every institution already owns it, the big money has probably already been made. And worse, if there's bad news, they'll all stampede for the exit at once, and that'll just crush the stock price. And finally, maybe most importantly, is M for market direction. O'Neill always said that even if you find the absolute best stock in the world, if you're in a bear market, you're just swimming against a very strong tide. His data showed that 3 out of every 4 stocks simply follow the overall market trend. Trying to make money when the whole market is falling is like trying to sail a ship in a hurricane. You absolutely need the wind at your back. So now you have the CANSLIM system. You know how to find potential winners. But here's the hard truth. Even the best system in the world is wrong sometimes. What separates the amateurs from the pros isn't just how they pick stocks, it's how they handle their losses. And for this, O'Neill had one simple, unbreakable rule. This right here is maybe O'Neill's most important lesson of all. His number one rule was to always cut your losses at 7%. No ifs, ands, or buts. No exceptions. If you buy a stock and it drops 7% from what you paid, you sell. End of story. It's such a simple rule, but emotionally, it's one of the hardest things for an investor to actually do. But this single act of discipline is what saves your money and allows you to live to fight another day. O'Neill had this brilliant little story he used to explain the dangerous psychology of holding on to a losing stock. He called it the turkey trap. Imagine a farmer sets a trap and catches 12 turkeys. Perfect. But as he's about to close the door, one turkey just wanders out. And he thinks, shoot, I'll just wait a second for him to come back in. But while he's waiting, 2 more walk out. Now he's thinking, man, I wish I'd just settled for the 9. He keeps waiting, hoping to get back what he lost, until eventually all the turkeys are gone.
The lesson is brutally simple. Take the small loss before it turns into a complete and total disaster. You know, O'Neill wasn't just a system builder. He was a myth buster. He used his mountains of data to expose all the popular Wall Street wisdom that was actually just terrible advice. Let's take a look at some of the biggest myths that he just completely debunked. First, this myth about buying cheap stocks with low price-to-earnings ratios. O'Neill proved that stocks are usually cheap for a good reason. They're mediocre companies. The biggest winners often look expensive right before they take off. Second, buying for dividends. O'Neill's data showed zero connection between dividends and a stock's performance. Third, the myth of diversification. O'Neill called it diversification. He argued it's way better to own a few great companies you understand deeply than 100 you know nothing about. And finally, the myth of only buying big, famous names you know. The truth is, the next Microsoft or the next Google is probably a company you've never even heard of, yet. So there you have it, the complete O'Neill system. A proven method for finding explosive stocks and a simple, powerful rule for protecting your money. He gave you the map, but you know, knowledge is only half the battle. The real challenge, the part that separates the winners from the losers, is having the discipline to follow the rules. To buy when you might be scared, and to sell when it hurts. O'Neill gave you the playbook. The only question left is, do you have the discipline to run the plays?
All right, let's dive into the story of a true stock market champion, David Ryan. This is a guy who took a massive, soul-crushing failure early in his career and flipped it into a system that delivered returns that are, well, they're almost hard to believe. We're going to break down his entire method, how he finds stocks, when he buys them, and, probably most importantly, when he gets out. So let's go ahead and open up this treasure chest.
Let's just start with this number, because it's pretty staggering. 1,379%. And no, that is not a typo. That was David Ryan's compounded return in just 3 years competing in the U.S. Investing Championship. So how on earth is a return like that even possible? Well, it wasn't just a lucky streak. It was the result of a super disciplined system, basically a treasure map for the stock market. So who is this guy? Well, David Ryan was a protege of the investing legend William O'Neill. He was so obsessed with the market that he basically told O'Neill's firm he'd take any job they had, he'd even work for free. Now that's dedication. And it definitely paid off. He didn't just win that investing championship once. He won it 3 years in a row, pulling in triple-digit returns each and every year. He did it because he saw the market in a way that most of us just don't.
And this quote right here, it really gets to the very heart of his whole philosophy. You see, Ryan didn't see the market as this big, confusing wall of numbers. He saw it as a grand adventure, a treasure hunt. And today, we're going to decode the exact treasure map he used to find those mind-blowing winners. But first, he had to learn a really, really tough lesson.
You know, it seems like every great trader has one of these stories. A moment of catastrophic failure where they almost lost it all. And for Ryan, this wasn't just some small setback. It was the single most important learning experience of his entire career. It's the moment he realized that to build a map that worked, he first had to figure out how he'd gotten so completely and utterly lost.
So check out this timeline. It's a classic story of boom and bust. He kicks things off in 1982 with 20 grand. By the next summer, he's on fire. He's more than doubled his money, running it all the way up to $52,000. I mean, he must have felt like an absolute genius, right? But then the market turned, and just a year later, his account had completely crashed down to $16,000. He didn't just lose every penny of profit, he actually lost some of his starting money. Devastating. So, this is the big question, right? What happened? A lot of people would have just given up after a hit like that. But Ryan didn't. Instead, he sat down and did a full-blown post-mortem. He went back and studied every single trade he made during that awful period to figure out the why behind his failure. And what he found? Well, it became the foundation for his entire championship-winning system.
His deep dive revealed 2 massive mistakes. First, when the whole market turned south into a bear market, he kept on trading aggressively, like it was still a bull market. He was trying to swim against a powerful tide. And second, he was buying stocks that were overextended. Basically, he was chasing stocks that had already made a big jump, like 15 or 20%. He was showing up to the party way too late and taking on way too much risk.
So by staring those mistakes right in the face, he was able to turn everything around. He built a system, a checklist, to find what he considered corporate buried treasure. And this is his treasure map.
It's a series of 6 specific clues that let him sift through thousands of stocks to find the very, very few that had the potential to be gigantic winners.
And here they are, the 6 clues on his map. You've got relative strength, EPS rank, the industry group, the share count, sponsorship, and number 6, something new. Think of each of these as a gate. A stock had to pass through every single one of these gates before he'd even think about buying it. So let's break them down.
Okay, clue number 1 is all about relative strength. This is just a fancy way of measuring a stock's price performance against all the other stocks out there. See, Ryan wasn't digging around for bargains or turnaround stories. Nope, he wanted to buy stocks that were already leaders, the ones already crushing the competition.
And he was super specific about it. A stock needed to have a relative strength score, or RS score, of at least 80. But really, he preferred stocks that were over 90. Now this is totally counterintuitive, right? Most people are looking for deals, thinking a strong stock is too expensive. But Ryan knew that leaders tend to keep on leading, and that strength, well, strength begets more strength.
All right, clue number 2 moves from how the stock is performing to how the company itself is performing. This is the EPS rank, which stands for earnings per share rank. This score compares a company's earnings growth to all the other companies. Ryan wanted to see powerful, accelerating profits because at the end of the day, huge stock moves are almost always fueled by huge earnings growth.
And just like with relative strength, he was aiming for the very, very top. His minimum EPS rank was 80, but he pointed out that a ton of his biggest winners had a rank of 99, the highest score you can possibly get. We're talking about companies whose earnings growth is in the top 1% of all public companies, the best of the best.
So the other 4 clues just add more layers of confirmation. Third is the industry group. A great stock in a terrible industry is like having the fastest boat in a drained lake. It's not going anywhere. So he only looked at companies in the top 50 strongest industry groups. Fourth, share count. He liked companies with fewer than 30 million shares. It's just basic supply and demand. With a smaller supply, a little bit of buying can send the price soaring. Fifth, sponsorship. He wanted to see that smart money, like big mutual funds, were already getting in, but not too many. Between 1 and 20% ownership was that sweet spot. And finally, number 6, there had to be something new, a catalyst, maybe a game-changing new product, a brilliant new CEO, something that could really ignite that explosive growth.
Okay, so once a stock passes all 6 of those tests, you might have a real treasure on your hands. But the big question is, when do you buy it? And this is where Ryan's method gets really fascinating. And again, goes completely against that old saying, buy low, sell high. Ryan's whole philosophy was buy high and sell a whole lot higher.
This explains the logic perfectly. So, when a stock is just bouncing around in a range, like you see on the left, you have what he called overhead resistance. Those are all the people who bought at the last peak and are just praying for the stock to get back to what they paid so they can sell and get their money back. But, and this is the key, when a stock breaks out to a brand new high, like on the right, all that resistance just vanishes. Every single person who owns that stock is now making a profit. There's nobody desperate to sell. It's like an open running field.
And to do this right, he had very specific signals. He would buy the absolute moment the stock punched through to that new high. Not the next day, but, and this is crucial, that breakout had to happen on huge volume, something like double the average. That was the proof that the big institutions were jumping in. He also had a little rule of thumb. One of the best signs of a winning trade is that it shows you a profit on the very first day.
But look, finding and buying the stock is really only half the battle. The most important part is how you manage the trade after you're in. Ryan was totally open about the fact that his win rate was only about 50-50. So if he was wrong just as often as he was right, how in the world did he get those 1,000% plus returns? The answer is all about ruthless, disciplined risk management.
This number, this is the whole key to the kingdom. 7%. That was the absolute ironclad maximum loss Ryan would ever take on a single trade. No excuses, no, oh, I hope it comes back. If a stock dropped 7% from his purchase price, he sold it. Period. End of story. That discipline is what kept him alive to play another day.
And this quote right here explains the simple math behind his whole strategy. He knew he was going to have a lot of small losses. He just accepted it as the cost of doing business, the price of admission. But by always cutting them off at 7%, he made sure that the huge profits from his few monster winners, the stocks that would go on to double or triple, would easily pay for all those small, disciplined losses.
And this just makes the contrast so incredibly clear. Just look at the holding periods. His losing trades, gone in less than 2 weeks. But his big winners,
He'd hold on to those for 6, sometimes even 12 months, just letting them run as far and as high as they possibly could. This is the absolute essence of that old trading mantra. Cut your losses short and let your winners run.
So, okay, we've got the treasure map, we've got the risk management rules, but Ryan always stressed that the real secret, the true magic, wasn't just the system itself. It was the mindset. It was his incredible passion and his total dedication to learning every single day. For him, the treasure hunt never, ever ended.
You know, when he was asked for the single most important piece of advice he could give to other traders, this was it. Keep a trader's diary. For every single trade, win or lose, he would physically write down exactly why he bought it. Now, this simple little habit did 2 incredibly powerful things. First, it constantly hammered the traits of winning stocks into his brain. And, even more important, it forced him to learn from his mistakes so he would never make the same one twice. That's how he turned that $16,000 account into a champion's portfolio.
Ultimately, what David Ryan's story really shows us is that the biggest treasures aren't always found on a stock chart. They're found in the lessons we learn from our own mistakes. He's given us the map, so the only question left is, what are you going to do with it? Thanks for tuning in.
All right, today we're going to talk about a guy named Marty Schwartz. He's a true legend in financial circles, not just because he made a ton of money, but because of the absolutely brutal journey he took to get there.
So just how good was he? Well, look at this number, 210%. That was his average return. And get this, it wasn't annualized. That was his average return across 9 different 4-month trading championships. In those contests, he would often make more money than all the other competitors combined. He was, without a doubt, one of the greats. But you know, the most fascinating part of his story? It isn't the winning. It's all the losing he did first.
You see, for 10 long years before he became this champion, Marty Schwartz was a consistent loser. I mean, he had a great job on Wall Street, earned a really good salary, but his personal trading account was just this black hole that swallowed money. And that's the real puzzle here, right? How does somebody who's a chronic loser completely transform into a trading legend?
Okay, so let's really dig into those frustrating early years. I mean, this is the period that nearly broke the guy. But, as we're about to see, it's also the period that ultimately made him who he was.
So on the one hand, you've got this guy who looks like a total success. He's a securities analyst on Wall Street, making very comfortable money. But behind the scenes, he was living this bizarre double life. It felt like every single dollar he made at his day job, he turned right around and lose it in the market. He was just trapped in this horrible cycle, and it haunted him. He kept asking himself, why wasn't I doing well when I was basically groomed to be successful? So where did the answer come from? Well, it turns out it was forged way before he ever even looked at a stock chart. His resilience, his toughness, it wasn't built on the trading floor. It was built years earlier, under intense pressure in totally different arenas. You know, Schwartz was always a grinder. In high school, he was an honor student, no problem. But then he gets to this prestigious school, Amherst College, and bam, all of a sudden, he's just average. For the very first time in his life, he had to genuinely struggle. He even had to get a tutor for calculus. But when he finally got it, he said it was like looking at a magnificent painting. He learned to actually love the process of working hard. And then came the Marine Corps. He said they basically pushed him to the absolute edge of his physical and mental limits, tore him down, and then built him back up from scratch. They tested him over and over, but he made it through, and it gave him this unshakable confidence that he could endure anything.
So you put those two things together, and they basically built the foundation of who he was. He learned how to handle pain, how to work like an animal, and how to truly believe that he could overcome any obstacle. He didn't know it yet, but this was the exact mental armor he was going to need to survive and eventually conquer the financial markets.
Okay, so he's got this incredible mental toughness. But what was the actual switch that flipped? What was the specific change that turned a decade of losses into a lifetime of legendary wins? Well, the first big shift was in his whole approach. For 9 years, he was a fundamental analyst. That's kind of like being a detective, right? You're digging into a company's financials, its earnings reports, its management, trying to figure out its true value. The only problem was, for 9 straight years, it just didn't work for him. So he completely switched gears to technical analysis. Instead of being a company detective, he became more like a weather forecaster for the market itself. He started studying charts and patterns, like moving averages, to understand what the market was actually doing, not what he thought it should be doing.
But here's the thing. As huge as that change in strategy was, it wasn't the real breakthrough. I mean, just swapping one type of chart for another doesn't magically make you a winner. No, the biggest transformation was entirely psychological.
This right here, this quote gets to the absolute heart of it. He finally realized his biggest enemy wasn't the market, it was his own ego. He had to stop trying to be right and just start trying to make money. For him, admitting he was wrong used to feel worse than actually losing the money. He finally learned how to just accept it, get the hell out of a bad trade, and live to fight another day.
And the results? Oh man, when he combined the new strategy with this new mindset, they were immediate and just explosive. In only 2 years, he took a $5,000 stake and turned it into $140,000. The losing streak was officially and dramatically over.
What's so cool about this is that he didn't just sort of feel his way through it. No, he turned it into a strict code, a set of rules that guided every single decision he made from then on.
So here are a few of his core principles. And notice something, they aren't about how to find the perfect home run stock pick. They're almost all about playing defense and being disciplined. He figured out that his biggest losses always came right after his biggest wins because he'd feel invincible and get sloppy. So he learned to pull back. He learned to stop bottom fishing, that super tempting but really dangerous game of trying to buy a stock right at its absolute lowest point. And above all else, he was obsessed with managing his risk.
And this idea, the uncle point, was absolutely central to everything he did. Before he even put $1 into a trade, he knew the exact price where he would get out if things went south. This is how you take your ego out of the equation. It's not a suggestion, it's a hard line in the sand. You decide how much you're willing to lose before you get emotional. The second the price hits that point, you're out. No second guessing, no hoping, no ego, just out.
I mean, it really all boils down to this one thing for him. He repeated it like a mantra. For Schwartz, trading wasn't about being a genius, it was about survival. And he believed that anyone who's actually successful would tell you the exact same thing. Protecting your money is the beginning, the middle, and the end of the game.
But, it's one thing to have a set of rules when the sun is shining and things are going well. What happens when the whole world is on fire? How do those rules hold up under the most extreme pressure you can possibly imagine?
Okay, let's paint the picture. It's October 19th, 1987, Black Monday. The U.S. stock market has its single largest one-day percentage drop in history. Total panic is in the air. And Marty Schwartz, he started that day betting the market would go up. He was completely, totally, 100% wrong.
So the market opens and it just goes into a nosedive. And this is where his years of discipline just took over. He didn't freeze, he didn't hope for a turnaround, he just followed his plan and liquidated his entire position. The price tag for that discipline was $315,000, a painful, painful loss, but it was also the decision that saved him.
And he said later, if he had just frozen up, or worse, if he doubled down on that losing bet, something called averaging down, he could have lost millions. He said his Marine training kicked in. They teach you to never freeze under attack. You either move forward or you retreat. Just sitting there while you're getting shelled is not an option. So he retreated, and by doing that, he saved his capital.
And this is the real kicker. This is the ultimate proof that his code worked. Because he bit the bullet and took that huge loss right at the beginning, he still had the money, and just as importantly, the mental clarity to trade the insane volatility that came after the crash. By playing defense first, he was able to go on offense when everyone else was completely wiped out. And get this, the year of the worst crash in history ended up being his single most profitable year ever.
So, what are the big lessons we can pull from Marty Schwartz's incredible story? Well, first, that having a long history of failure doesn't mean you're doomed forever. Second, that mental toughness, that resilience you build through hardship is every bit as important as your strategy. Third, and this might be the biggest one, you have to get your ego out of the way. And finally, that strict, disciplined risk control isn't just a good idea, it's everything.
Schwartz had this weird love for trading because it's just so brutally honest. There's nowhere to hide, there are no excuses, the market tells you in plain numbers whether you are right or wrong. It forces you to confront yourself in a way that, let's be honest, most of us try to avoid our entire lives.
And that really brings us to a final question, one that goes way beyond the trading floor. In our jobs, our relationships, our lives, we all screw up. We all make mistakes. What Marty Schwartz's journey teaches us is that the key isn't to never make mistakes. It's having the guts to admit them quickly, cut our losses, and move on. So the real question he leaves us with is this: are you willing to be wrong, to let go of your ego, in order to ultimately win?
All right, let's dive into the mind of a true market maverick, Jim Rogers. You've probably heard the name, co-founder of the legendary Quantum Fund. This is a guy who built an absolute fortune by looking at the world completely differently than everyone else, following a philosophy that is just brilliantly simple. This quote, honestly, it tells you almost everything you need to know. For him, investing isn't about frantic action or some complicated secret formula. Nope, it's all about having the extreme patience to wait and wait until an opportunity is so ridiculously obvious that you just can't miss. And that's exactly what we're going to unpack today, how he finds those moments. Okay, so first things first, we have to deal with a bit of a paradox, a real head-scratcher. Jim Rogers is one of the most famous market wizards of all time, but he'll tell you straight up that he's not a trader. How on earth does that make any sense? Now, he's not just being modest here. He genuinely means it. In his mind, a trader is someone who's glued to the screen, trying to catch every little daily wiggle in the market. Rogers, he's playing a totally different game. He sees himself as a detective, an analyst who spots massive, fundamental changes happening in the world, shifts that take years to play out. He's not trying to nail the exact top or bottom. He's trying to ride the entire tidal wave. This brings us right to the heart of it all, the absolute bedrock of his entire investment philosophy. For Rogers, any major investment he makes has to pass a simple two-part test. And this little rule is pure genius because it automatically filters out all the noise and just leaves him with those fish-in-a-barrel setups. I mean, just think about that question. How do you find a setup that's so good, the odds are so stacked in your favor that your downside is just tiny? It sounds like the Holy Grail, right? Almost impossible. But his whole approach is built to answer this exact question. And here is the secret sauce. It's 2 simple steps. First, you have to find value. He's basically a bargain hunter on a global scale. He looks for things that are hated, ignored, and beaten down. Assets that are so cheap, they're basically lying on the floor. But, and this is the absolute key, that's not enough. A cheap asset can stay cheap forever. That's why he needs part 2, a catalyst. This is the spark. It's some specific event coming up that's going to force everyone else to wake up and see the value that he saw ages ago. And this case study from Germany is the perfect example. Picture this. It's 1982. He's looking at the German stock market, which had gone absolutely nowhere for 21 years. Meanwhile, the German economy was booming. That's what you call deep value. So, check. Step 1 is done. But what's the catalyst? An election. Rogers figured the pro-business party was going to win, which would unleash all kinds of new investment. He was so convinced he was right that he bought a ton of German stocks and literally told his broker, "Don't even call me with prices." He knew it would take time, and boy, did it pay off. So that's how he buys. But what about the other side of the trade? If buying value is his offense, then his defense is all about betting against emotion. In fact, he actively goes out looking for moments of total, widespread delusion in the market. You know how it is. Every market cycle swings back and forth between these 2 extremes. At the top, you get euphoria. Everyone's shouting, "This time is different," and prices just go vertical. At the bottom, it's sheer panic. The world is ending, and people are dumping perfectly good assets for pennies on the dollar. For most people, these moments are terrifying. For Jim Rogers, they're a massive opportunity. And listen carefully to how he says that. He doesn't say, "When I see hysteria, I sell." No. The hysteria is just the signal. It's the trigger for him to start doing his homework. When the crowd turns into a mob, all stampeding in one direction, that's when he pulls out his notepad and starts figuring out if the fundamentals actually support going in the exact opposite direction. And he wasn't just talking a big game. He made some of the most legendary calls in history this way. Back in 1980, when everyone was panicking about inflation and piling into gold, what did Rogers do? He shorted it. He bet against the madness. And he did it again in 1987 when he saw a massive bubble in the US stock market. He looked at the hysteria and bet against it. On October 19, 1987, the market proved him right in the most spectacular, brutal way possible. You know it as Black Monday. The Dow Jones plummeted 508 points, a collapse of more than 22% in a single day. Absolute chaos. So what did Jim Rogers think of this historic market crash, this day of financial ruin for so many? Well, it just so happens that October 19th is his birthday. So yeah. While the rest of the world was in total shock, he was cashing in on one of the greatest contrarian trades ever made. That tells you everything about his mindset. So you might be thinking, this all sounds great. But there's one skill that underpins all of this. Waiting for value, waiting for hysteria, and it's by far the hardest one to master. It's the discipline, the sheer willpower to do absolutely nothing. Most of us feel this constant itch to be doing something, right? You make a good trade, you immediately want to find the next one. You take a loss, you feel this desperate need to make it back right away. Rogers says that impulse is your worst enemy. It's a highway to the poorhouse. The real opportunities, the ones he calls money lying in the corner, they're incredibly rare, and your job is to sit on your hands until one shows up. He didn't learn this lesson in a book, though. He learned it the hard way. Early in his career, he shorted a company called Memorex. His analysis was spot on. The company was wildly overvalued, but he was too early. The market hype was just too strong, and the stock kept climbing, forcing him out of his position for a total loss. And here's the devastating part. He was eventually proven right. The stock did collapse, but only after he'd already been wiped out.
You know, that painful experience taught him what is maybe the most important lesson in investing. Markets can stay irrational way longer than you can stay solvent. Being right about the facts isn't enough. You have to survive the market's insanity. And that's why today he waits, not just for the right idea, but for the right price and the right moment of extreme emotion.
So if we boil all this down, the patience, the value, the contrarian bets, what's the one thing that holds it all together? It's really simple, but incredibly hard to do. It's independent thought. Just look at this comparison. On one side, you have all the classic lines, the trend is your friend, the market knows best. It's conventional wisdom. On the other side is how Rogers thinks. He starts from the assumption that the market is probably wrong about something. For him, following the crowd is a guaranteed recipe for getting average, mediocre results. And that's really his core message, isn't it? Real success, the big home runs, they don't come from being part of the consensus. They come from doing your own research, forming your own opinion, and then having the courage to act on it, especially when everyone around you is saying you're crazy. It's about being the one person who can see that the popular story just doesn't add up. So let's wrap it all up with his 5 key principles. 1. Buy deep value, but only if you see a catalyst on the horizon. 2. Sell hysteria. Use the market's emotions as your guide. 3. Be incredibly patient. Master the fine art of doing nothing. 4. Be flexible. You can find opportunities anywhere in any asset. And 5, the most crucial one of all, think for yourself. The biggest money is made by seeing what everyone else misses. And that's the real question to leave you with. Following the crowd, it feels safe, right? It's comfortable. But Jim Rogers' entire career is a testament to the idea that the path that feels safest is almost never the one that leads to incredible results. He challenges all of us to stop asking what's popular and start asking what's true. Thanks for joining us.
Today, we are digging into the wild story of Mark Weinstein. He's a legendary trader whose journey is honestly a masterclass in failure, resilience, and eventually, total mastery. I mean, this is a story that starts with him losing his entire life savings in just 3 days, and it ends with one of the most unbelievable track records in the history of trading.
So let's just start with this quote, because it sounds completely backward, doesn't it? We usually think of top traders as these fearless, aggressive titans of the market. But for Weinstein, fear wasn't some weakness he had to get over. Nope, it was a tool, something to be sharpened into this high-precision instrument. Let's get into how he did it. You know, Weinstein's career didn't kick off with some brilliant strategy or a deep understanding of finance. Not at all. Back in 1972, he was a real estate broker, just desperate for a change. So he jumps into the commodity markets, knowing, and these are his own words, absolutely nothing.
He opened his first account with every single penny he had. This wasn't just some play money or risk capital. This was his entire net worth, thrown on the line in a game he didn't even know how to play.
And just like that, it was gone. He followed a recommendation, made a single bad trade in corn, and got wiped out in 3 days. He basically jumped into an overbought market at the worst possible moment and was left with just $600. What a brutal, immediate lesson.
But here's the thing. That catastrophic failure didn't scare him off for good. Instead, it just lit this fire under him. For the next 6 months, the guy worked relentlessly, 7 days a week, selling real estate. He wasn't just trying to earn back the money. He was totally consumed, obsessed with understanding what just happened to him. And for the next few years, that obsession really paid off.
He literally plastered the walls of his apartment with charts, learned everything he could about technical analysis, and he built a small fortune. But, as often happens, with that success came this really dangerous sense of invincibility. Hubris was definitely creeping in. So he's on a trip to Europe, and he sees something that completely shifts his focus. A castle in the south of France, moat and all, for sale for $350,000. Now, he already had more than enough money to just buy it outright, but he made this fateful decision. He decided his very next trade was going to pay for that castle.
And this, right here, is the critical error. He stopped trading the market. He was now trading for a material goal. The market wasn't about signals or risk management anymore. It was just a tool to get his castle. And that desire, that specific target, completely blinded his judgment.
He went all in, putting on this massive long position in soybeans. And at first, it worked. It went up. But then, disaster. The market reversed and just collapsed so fast the trading was halted. It locked the limit down. He was completely trapped. Think about that. Unable to sell his position. At any price.
For 5 straight days, all he could do was watch as the market opened the limit down again and again, and his account just bled money. He was losing about $125,000 a day. The final price tag for his castle-driven mistake, a loss of over $600,000, nearly half of his entire trading account. This was so much more than a financial loss. It was a deep psychological trauma. That feeling of being totally powerless, of being cheated by the very market mechanics that are supposed to protect you. It pushed him to a psychotic state. He literally tore all the charts off his walls and nearly quit trading for good.
So this was rock bottom. To keep going, he had to completely rebuild his entire philosophy of trading from the ground up, and it all started with a powerful and pretty painful lesson from a friend. He started trading options with a friend who was, by all accounts, a phenomenal trader. On one of his first trades, he followed his friend's advice and immediately lost $40,000. He was devastated. But then, 2 days later, his friend revealed he'd actually done the opposite trade in a secret account for him. It wasn't some cruel joke, it was a brutal lesson. Never, ever place blind trust in anyone else. You have to rely on yourself.
That lesson in self-reliance was the final piece of the puzzle. He realized his mentor's tolerance for big losses just didn't work for his own psychology. So in 1980, he went solo. He was determined to create a brand new style, and it was defined by just one thing: an absolute obsession with avoiding losses.
But there was still one ghost in the closet: the soybean market. For years, he couldn't even look at a soybean chart. But he watched it, peripherally, waiting. He said he was like a Sicilian whose wife had been murdered, just waiting 10 years for the perfect moment for revenge. Finally, in 1988, everything lined up. He jumped back in and made all his money back and then some. It was, as you can imagine, a total catharsis.
So vindicated and basically reborn, Weinstein's new method, forged in the fires of his absolute worst failures, began to produce results that are, honestly, they're almost impossible to believe.
So, to test his new style, he enters a 3-month options trading contest. He starts with a $100,000 account and he turns it into over $900,000. That's a staggering 900% return. And it was all the validation he needed that his new, hyper-cautious approach was incredibly powerful.
Now, his mindset is just fascinating, and he explains it with these 2 animal analogies. For his long-term position trades, he says he's like a cheetah. He'll hide in the bush for a week if he has to, just waiting for the sick, lame baby antelope, the trade that has almost 0 chance of failure. But for day trades, he's a sparrow, darting in and out, taking tiny little pieces of bread, just too fast to ever get caught.
Okay, the results of this method are just staggering. From the day he went out on his own in 1980, he claims to have had 0 losing months and 0 losing weeks. And in one 2-year period, he recalled having only 3 losing days. I know, it sounds completely preposterous, but the author of the book he was featured in confirmed that it was, at the very least, incredibly close to the truth.
So after this incredible journey, from total, abject failure to near-perfect performance, what's the core wisdom that Weinstein lives by? What can we really learn from his transformation?
While his core rules are a direct reflection of his scars. Don't be arrogant, he learned that with the castle. Be your own person. That was the hard lesson from his mentor. And know when to stay out. That's the patience of the cheetah. You can see how each rule was paid for with a really painful experience. This might be his most profound insight. If you don't learn how to process a loss, how to accept it and learn from it, you'll just end up blaming the market instead of fixing your mistakes. It's the losses, not the wins, that provide the most valuable tuition you'll ever get.
And the crucial point is this powerful reversal of human nature. See, most people are afraid their profits are going to disappear, so they sell way too early. And they hope their losses will turn around, so they hold on way too long. Weinstein argues you have to do the exact opposite. You have to cut your losses quickly out of fear and let your winners run with hope.
And that, right there, is the ultimate lesson of his story. He didn't eliminate his fear. He harnessed it. He used the fear of another catastrophic loss to force himself to wait, to be precise, and to achieve a level of discipline that turned him into one of the greatest traders of all time. So the question for all of us is, how can we do the same?
Let's talk about a market wizard you've probably never heard of. A guy who built a legendary career by basically breaking all the rules, especially the one that says you need a big, flashy Wall Street personality. His name is Brian Gilbert.
So, picture this. It's the day of the 1987 stock market crash. Chaos everywhere. One trader gets his face plastered on the cover of Success magazine for making $4 million in 72 hours. Meanwhile, Brian Gilbert has a simple question. I made $4 million in 20 minutes. How come I'm not on a magazine cover? And get this, that wasn't ego. It was just a fact, and it points to a deeper truth. Some of the most successful traders out there are the ones you never see. So how do you do it?
You know, when you think of a trader managing millions, you probably picture someone intense, right? Wired on coffee, practically vibrating with stress. Well, Brian Gilbert is the complete opposite of that. He's described as being so chill that when he talks about his job, it sounds like he's just telling you about a nice vacation, not battling it out in the Chicago T-bond pit, which was one of the craziest, most physical trading floors on the planet. That calm demeanor, turns out it's the first huge clue to his genius.
So here's our game plan for this explainer. We're going to start with the unassuming trader himself. Then we'll follow his wild path from backpacker to broker. We'll dig into the impossible dual role he tried to play and the massive price he paid for it. Then we get to the really good stuff, how to listen to money. After that, we'll tackle the psychological battle of mastering your inner market. And finally, we'll boil it all down to the final rules of the game.
Okay, let's kick things off with the central paradox of Brian Gilbert. Here's a quiet, low-key guy who achieved absolutely explosive success in a business that celebrates loud, in-your-face personalities. So, how does a ghost thrive in a world built for giants?
Well, that brings us to his origin story, which is, let's just say, unconventional. Gilbert didn't have some fancy finance degree. His path to the trading floor was about as far from Wall Street as you could possibly get.
I mean, just look at this timeline. It's nuts. In '76, he graduates college, and what does he do? He backpacks across the U.S., unloading railroad cars for cash at one point. Later that year, on a total whim, he answers an ad and winds up in a sketchy boiler room. He quits that, and by early '77, he just walks into an office and gets a cold calling job for $800 a month. And by September of that same year, at just 25 years old, he's on the floor of the Chicago T-bond market. It's just this dizzying, improbable climb.
So how on earth did he pull that off with basically zero knowledge? He's honest about it. He says, I snowballed them at first, but I listened, and I learned from the questions they asked me. And that's the key right there. His early success wasn't about what he knew. It was about his incredible knack for listening, for adapting, and for basically using his own clients' questions as his personal textbook.
And this is where things get really intense. This leads us to the first major conflict of his career. For 3 solid years, Gilbert lived this double life. He was one of the biggest brokers and one of the biggest traders in the exact same market. And that combination created a pressure that was almost unbearable. You can see the fundamental problem right here. As a broker, your number one duty is to your client, period. But as a trader, your duty is to your own bottom line. These two things are on a constant collision course. Just imagine, a huge client order lands on your desk that's going to move the market directly against your own personal trade. Who wins? The client has to. You have to execute their order first, even if it's going to cost you a personal fortune.
After living that nightmare firsthand, Gilbert's conclusion was just absolute. If you are a broker, you are not a trader. If you are a trader, you are not a broker. He realized that the two roles are just fundamentally incompatible if you want to be great at either one of them without, losing your mind or your integrity. And the personal cost was huge. Gilbert said that 3-year stretch was just
total exhaustion, that it probably took years off my life. He was working insane hours, just completely burning himself out. But you know, this brutal experience wasn't a failure. It was the fire that forged the next and most important stage of his career.
Okay, so this brings us to the major turning point, the big aha moment for him, learning how to listen to money. After the burnout of that dual role, Gilbert had this profound realization. His greatest strength wasn't having a strong opinion, it was reacting to what the market was actually doing.
His first go at being a full-time trader was rough. He was bullish, betting on the market to go up during the Great Bear Market of 1979. So why? Well, because he was listening to the so-called renowned people. The experts at big banks like Citibank. They kept buying all the way down, and as a young, naive kid, he just followed them, thinking these guys can't be wrong. But they were. Big time. And this quote right here perfectly captures his epiphany. He said, "I had learned that an opinion isn't worth that much. It is more important to listen to the market. I became a reactive trader as opposed to an opinionated trader." You see the shift? He stopped trying to predict the future and just started paying attention to the now. He let the market tell him what to do, not the other way around.
So, what does it actually mean to listen to the market? For him, it wasn't about charts and data, it was about people. His method was basically a 4-step process. First, he'd connect. He talked to over 25 traders he trusted every single day. Second, he'd listen. But he wasn't just listening for their opinions, he was listening for their emotions. Were they nervous, confident, scared? Third, he'd identify. He'd figure out who was hot and making money, and who was cold and losing. And finally, he would act based on that collective feeling. If 20 out of 25 people were nervous shorts, he knew the market was probably about to rip higher.
And that's the perfect segue into our next section. Because, it's one thing to understand the market's psychology. It's a whole other ballgame to control your own. This is all about mastering your inner market.
Gilbert has this really fantastic way of breaking down a trader's year. Think of it like this. For about 4 months, you're hot. You feel like a genius, you can't lose, you can't wait to get to work. Then for 2 months, you're cold. Nothing works, everything you touch goes wrong, and you're just miserable. And for the other 6 months, you're just treading water, making a little, losing a little. It's a nonstop emotional roller coaster.
And the result of that relentless cycle? You never sleep because you are constantly thinking too much about trading. It is an all-consuming thing. This is exactly why self-knowledge isn't just a nice-to-have in trading, it's a survival skill. You have to learn how to manage your own head, to not get too high on the wins or too crushed by the losses.
When you ask him what causes most traders to fail, his answer isn't about having a bad strategy or being bad at math. It all comes down to psychology. He says, most traders who fail have large egos and can't admit that they are wrong. That inability to accept a loss, to just say, well, I messed up, that is the single biggest flaw that will absolutely wipe you out.
Okay, let's pull all this incredible hard-earned wisdom together. We're at our final section, the final rules of the game.
Here it is, Gelber's core rulebook, boiled down from decades of experience. Rule number 1, the absolute primary rule. Never add to a losing position, period. The most common mistakes he saw? People over-trading and always begging others for tips. His own playbook for a losing streak was a 3-step process. First, trade smaller. If that doesn't work, take a break, get away from the screen. And if you're still losing, time for the nuclear option. Wipe the slate clean.
And this is where his discipline becomes almost superhuman. Someone asked him if wiping the slate clean also meant getting rid of his winning positions. His answer was absolute. They are bound to turn against you too. Just think about that for a second. When you're in a slump, you get out of everything. You hit the big red reset button, even if it means ditching a profitable trade, all for the sake of regaining your mental clarity and confidence.
So, when you boil it all down, what's the ultimate lesson from Brian Gelber's amazing career? It's not some secret formula or a black box trading system. It's a mindset. It's all about flexibility, being able to go with whatever's working. And it's about the suppression of ego, understanding that the goal is to make money, not to be right.
In the end, Brian Gelber's real genius wasn't about out-predicting the market. It was about out-knowing himself. His greatest trading tool wasn't some fancy chart or a complex algorithm. It was a mirror. Which really just leaves us with one final question to think about. What's yours?
So what does it take to become an absolute legend in the most chaotic financial arena on Earth? It's not just about being smart, it's not about being lucky, it's a completely different kind of mindset. All right, let's dive into the story of Tom Baldwin, a man who, for a time, was the undisputed king of the trading pet.
Okay, I want you to picture this. The Chicago Board of Trade's Treasury Bond Pit. Now, this is not some quiet office with blinking computer screens. No. This is a physical octagon, just crammed with over 500 traders, all pushing, shoving, screaming orders at the top of their lungs. They literally called it institutionalized bedlam. It was a place so massive and so frenzied that one side of the pit often had no clue what was happening on the other.
And right there, in the eye of this hurricane, one man stood out. He was like this calm, unchallenged giant, a trader who could move entire markets with just a single hand gesture, a name that just echoed with fear and respect through the entire pit, Tom Baldwin.
But here's the real kicker. This guy wasn't some Wall Street prodigy with a PhD and a trust fund. He showed up with just 25 grand to his name, zero prior trading experience, and a family to feed. I mean, on paper, this was a recipe for absolute disaster. So how did he not just survive but completely conquer this world? Well, that's the mystery we're about to unravel. To really wrap your head around Baldwin's dominance, you first have to grasp the sheer, unbelievable scale of his trading. This is what separated him from the crowd and turned him into a living legend on the floor.
So, on a pretty average day, Tom Baldwin might trade over 20,000 contracts. Now, to put that in perspective, that is the equivalent of $2 billion in face value T-bonds. That's billion with a B. This didn't just make him a big fish in a small pond. It put him in the exact same league as the major institutional players. We're talking the big banks, the huge investment firms. He was basically a one-man army in the world's biggest futures market.
Now here's where the story gets really interesting. Because on paper, Tom Baldwin should have failed. Miserably. His background was the complete opposite of what you'd expect from a trading superstar.
Then this timeline just shows you his incredible trajectory. It's 1982, he quits his job at a meatpacking firm, takes his entire life savings, that 25 grand, and puts it all on the line to lease a seat. And get this, he was profitable from day one. In fact, he said the most he was ever down in a position was just 19 ticks. That's the smallest possible price move in the market. It's an almost unbelievably small amount for a rookie. And before his first year was even up, he was a millionaire.
So what was his secret? Well, when people would ask him how he got an edge with absolutely no background, his answer was kind of shocking. He genuinely believed that a formal education and deep market theory were actually a disadvantage. For him, it wasn't about what you learned in a book. It was about what you learned by standing in that pit for 6 hours a day, every single day, just observing the patterns, the flow, and the other players.
Okay, so if it wasn't about being book smart, what was his actual secret sauce? Let's break down the Baldwin method, a really simple but brutally effective approach to winning in the total chaos of the pit. At his core, Baldwin was a master scalper. Now, what this means is he wasn't trying to predict big, long-term market moves. Nope, he was in and out of trades in minutes, sometimes even seconds, just trying to capture these tiny little price fluctuations. The entire goal was speed and, most importantly, minimizing his exposure to risk. So these were his battlefield rules. He held trades for the shortest possible time because, as he famously said, that is less risk. Simple as that. And while he might occasionally go for a big home run, his bread and butter was snatching just 4-tick profits on his massive positions. Now, he wasn't trading completely blind. He'd look at a 6-month bar chart to kind of get a feel for the day's bias. But after that, he let the raw energy of the pit guide his every single move. Okay, now we get to the real secret. The thing that separated him from pretty much everyone else. It wasn't just his method, you see. It was his mindset. This is where he went from being just a good trader to a legendary one. So what did Baldwin himself believe was the ultimate key to success? I mean, what did he have that the 99% of traders who failed didn't? This, right here, is his most famous and maybe his most important piece of advice. He believed that the second you start thinking, wow, I'm down $10,000, that could have been a new car. You're dead in the water. For him, money was just a way of keeping score. It had no real-world meaning during the trading day. And it was this detachment that allowed him to operate without the fear that paralyzes almost everyone else. So let me tell you this legendary story that just perfectly captures his fearlessness. He's only 6 months into his career. A broker in the pit throws out a massive bid for 100 contracts, almost as a joke, not expecting anyone to take it. On a whim, basically on a dare, Baldwin, who had never traded that size before, instantly sells him all 100. The market immediately moves in his favor. Now he's scrambling, yelling at 10 different people to help him cover the position because he doesn't even know how to handle that kind of volume. He makes the profit, but his clearing firm calls him in, absolutely furious at the insane risk he just took. His response, 2 days later, he did it again.
All right, here's another piece of his advice that seems to fly in the face of all conventional wisdom. I mean, every trading book ever written tells you to cut your losses quickly. Baldwin said the exact opposite.
Now, the crucial point here is that this isn't about ignoring your losses. It's about not panic selling. He argued that most traders get out of a losing trade just to stop the emotional pain. He believed if you could just endure that pain a little longer and stay patient, you could often find a much better moment to exit. So instead of taking a big loss in a panic, you could wait for a small bounce and turn a 5-yard loss into a 2-yard loss. It takes immense discipline, but for him, it was key.
So Baldwin's whole philosophy really gives us a clear roadmap for understanding the difference between the traders who win big and pretty much everyone else who tries and fails. First, let's just be clear about the odds because they are brutal. According to Baldwin, the rule of thumb is that 80% of people who come to the floor fail. They lose all their money and they're gone. Another 19%, they manage to survive, but they don't really get rich. That leaves a tiny 1% who become truly, massively successful. Those are the statistics of the trading pit.
And this table just lays out the key traits he identified. The winners, they work relentlessly and they persevere through the tough times. They have absolutely no fear because remember, they don't think about the money. They are incredibly patient, waiting for the perfect spot, while the losers force trades because they just crave action. And finally, winners have no ego. They can admit when they're wrong and get out, while losers let their pride completely destroy their accounts.
And this quote speaks directly to that last point on ego. Baldwin was adamant that the moment you start to believe you're infallible, that you're smarter than the market, is the exact moment you're about to get crushed. Success requires constant humility and the ability to adapt, not a belief that you're some kind of genius.
Ultimately, Baldwin was a realist. He knew the game he was playing. His aggressive, high-stakes style carried enormous risk, and he knew that any day, some fluke move in the market could wipe him out completely. But this wasn't a complaint. It was just a cold, hard acceptance of the reality of his profession. He lived by the sword, and he knew he could die by it.
And that really brings us to the final thought here. Tom Baldwin's story isn't just about trading stocks and bonds. It's about the psychology of performing under extreme pressure. What he teaches us is that the biggest obstacle usually isn't a lack of knowledge, it's the presence of fear. Fear of losing money, fear of being wrong, fear of missing out. So the question to leave you with is this. In your own field, whatever it is you do, what is the fear that's holding you back? And what would become possible if you could finally conquer it?
Today, we're going to dive into the incredible story of Tony Saliba. He's a legendary trader whose career is honestly a masterclass in failure, discipline, and just spectacular success. What makes him so fascinating is how he turned a near-total wipeout into a multi-million-dollar empire. And let me tell you, his journey offers some of the most powerful lessons in risk and strategy you will ever find.
But here's the thing, our story doesn't start with a big win. It starts at the absolute lowest point a person can possibly reach. So picture this, it's May 1979 and a DC-10 crashes right at Chicago's O'Hare Airport. At that exact moment, a young trader named Tony Saliba, who had just lost pretty much everything, felt so completely crushed that he actually wished he'd been on that flight.
So you have to ask yourself, how does someone get to a point that low? I mean, that's just rock bottom. And maybe more importantly, how do you claw your way back from that? Not just to survive, but to become one of the most successful traders of your generation? Well, that's the journey we're about to explore.
And here's how we're going to break it down. We'll start with that initial disaster. Then we'll look at his radical one-lot comeback. From there, we'll unpack the brilliant strategy he developed, witness his first massive win, see how he handled the chaos of the '87 crash, and finally, we'll distill the core philosophy that guided him through it all. Okay, let's rewind the clock to 1978. A young Tony Saliba arrives on the floor of the Chicago Board Options Exchange just full of confidence. He manages to get a $50,000 backing from another trader, and he just jumps right in. And what happens next? Well, it's a classic story of Evo meeting a brutal reality check.
I mean,
Look at how fast this all happens. It's staggering. In just 2 weeks, he turns 50 grand into 75. He's on top of the world, thinking, I'm a genius. But here's the catch. He was making a classic rookie mistake. The veteran traders were selling and he was buying. He was basically on the wrong side of their profitable trades. So when the market went flat and all that volatility just vanished, poof, the value of his positions just evaporated. In 6 short weeks, his account implodes, leaving him with only $15,000 and just this feeling of utter despair.
So there he is at rock bottom. His backer is about to pull the plug, and Saliba has a choice. He can quit, or he can completely reinvent his entire approach to trading. This right here, this is the critical turning point in his story, where he goes from ego-driven gambling to disciplined, methodical trading.
So he goes to the veterans on the floor for advice, and the wisdom they gave him, it changed everything. They told him to stop trying to get rich quick. Instead, they said, look, be disciplined, do your homework. You might not get rich, but you can make $300 a day. And he realized he didn't need to hit home runs anymore. He just needed consistent base hits. The goal wasn't a giant jackpot anymore. It was a steady, reliable income. As he put it, it was like a light bulb went out.
So with that, he creates a whole new set of rules for himself. It was all about this chipping away approach. He actually switched from trading those crazy, volatile Teledyne options to the much calmer Boeing options. There, he could just scalp for tiny, consistent profits all day long. This period right here is what forged the incredible discipline that would define the rest of his career.
Now, this new mindset was really put to the test when he eventually went back to that volatile Teledyne pit. But instead of jumping back in big, he traded just one contract at a time, a one lot. And you gotta imagine the scene. The veterans, they're trading 10, 20 lots at a time. They see him as a total joke. They openly mocked him, calling him one lot for almost a year. But he just swallowed his pride, stuck to the plan, and slowly, methodically rebuilt his capital and his confidence.
Okay, so this is where it gets really interesting. Let's look at how all that new discipline evolved into a really sophisticated strategy. Saliba developed what he called a matrix approach. It was this brilliant 2-part system designed to do 2 things at once: grind out steady profits while also being perfectly positioned for one of those rare, explosive market events. All right, so part 1 was his engine for consistent income, something called butterfly spreads. The easiest way to think about it is that every option has a ticking clock. As it gets closer to expiring, its value naturally decays, especially if the stock isn't moving much. A butterfly spread is just a clever way to profit from that time decay. In a calm market, this was his bread and butter, the strategy that literally paid the bills, day in and day out.
Then there was part 2, his lottery ticket. He would build what he called an explosion position. This was a trade that was structured to have very limited risk on the downside, but massive, open-ended potential on the upside. It was basically designed to pay off spectacularly if the market made a sudden giant move. Didn't matter if it was up or down, or if volatility itself just went through the roof.
And here is the absolute genius of how these 2 parts work together. The steady, predictable profits from his butterfly spreads, the ones that made money as time just ticked by, he used that cash to pay for his explosion positions, which were essentially bets on future chaos. Think about that. He was using his daily income to buy cheap insurance that had the potential to pay off 1,000-fold. It was just a brilliant way to completely control his risk while still having enormous upside.
So, with his discipline forged and his 2-part strategy locked in, the stage was set for his first legendary trade. And this is where all that ridicule for being one lot and all that patient preparation was about to pay off in a way that would change his life forever.
For over 10 straight trading days, he patiently starts building a huge position in these cheap, out-of-the-money calls on Teledyne stock. Now, the rest of the traders on the floor, they think the stock is peaked. So they are aggressively selling those exact same calls, just hammering his position every single day. But Saliba, he just stood his ground, buying everything they threw at him. It was a lonely, contrarian bet against the entire crowd.
And then, it happened. The explosion he had positioned for. With the stock trading around $155 a share, Teledyne suddenly announces it's going to buy back its own shares at $200. This was the catalyst. This was the news that sent the stock into the stratosphere.
The result? Well, those call options he'd been patiently buying for pennies on the dollar, they were suddenly worth a fortune. He made millions, virtually overnight. The trader everyone called one lot was now a millionaire.
His strategy was spectacularly, undeniably validated. A few years later comes the ultimate test for any trader, the Black Monday stock market crash of October 1987. I mean, for most people, it was a day of absolute financial ruin. But for Saliba, thanks to his unique strategy and discipline, it was one of his most profitable periods ever.
And right here, you can see the crucial difference. The traders who got buried were just reacting. They assumed it was just another dip, so they kept buying more and more on the way down, completely losing sight of their total risk. Saliba, on the other hand, was prepared. Remember that explosion position? It was designed to profit from a big move in either direction. He was insured, and most importantly, he always knew his exact worst-case loss on any position.
This quote really gets to the heart of his psychology. When he says he starts with a clean slate, it doesn't mean he has no trades on. It means his risk is so perfectly defined and hedged that he isn't emotionally paralyzed by fear. So while all the other traders were shell-shocked and frozen, he was able to think clearly and actually seize a historic opportunity.
So, when you boil it all down, what are the key lessons we can take from this incredible journey? Saliba's story isn't just about making money. It's about a powerful philosophy of preparation, discipline, and in the end, a really different definition of what success truly means.
These are his core rules. First, respect the market. Never believe you're smarter than it. Second, do your homework every single night, planning for every possible what-if scenario. Third, discipline is just non-negotiable. And finally, and this is the big one, always define your risk before you get into a trade. Know your worst case. Honestly, these aren't just rules for trading, they're principles for managing uncertainty in pretty much any field. But you know, perhaps the most profound lesson came after he achieved all his financial goals. His early dream was to be a millionaire by 30 and then retire. He actually did it by age 25. But after just a few months of retirement, he was profoundly bored and went straight back to the trading floor. He realized that the money itself, that wasn't the ultimate prize.
And that really leaves us with a final question. Saliba chased the numbers, and he won the game, only to discover that true success for him was about the challenge, the process, and mastering his craft. It kind of forces us to ask ourselves, once you hit your own targets, what's really going to define your success?
Welcome back. All right, let's just jump right in. Have you ever wondered what really separates the top 1% of traders from literally everyone else? Is it some secret system? Do they have better charts? Or is it something way deeper? Today, we are unpacking the psychological blueprint for winning, and we're basing this on the incredible work of research psychologist Dr. Van K. Tharp. This is a guy who has spent his entire career decoding the minds of the world's absolute best traders.
You know, this is the million-dollar question, isn't it? I mean, so many smart, driven people get into the markets. They've got the books, they've taken the courses, they have these complex strategies, and they just consistently lose money. It's so frustrating and it's so common. In fact, Dr. Tharp himself started out by losing money so fast and so consistently, he just knew the problem had to be something to do with him.
And this is the fundamental truth he discovered. The market, it's not your real opponent. It doesn't care about you. It doesn't care about your positions or your feelings. The real battle, the one that truly determines whether you win or lose, is fought entirely inside your own head. This is an internal game, and to win it, you have got to master yourself first.
So here's our game plan for breaking this all down. First up, we're going to pinpoint the trader's real enemy. Then we'll look at Dr. Tharp's composite sketch of a losing trader and check out the 5 big psychological hurdles they face. Once we've diagnosed the problem, we're going to pivot to the good stuff, the solution. That's a blueprint for success built on 3 pillars of winning. And finally, we'll wrap it all up with the real key to winning the mind game. Let's get to it. Okay, so if the market isn't the enemy, then what is? Well, to answer that, we have to look way beyond the charts, the indicators, and all the breaking news. We've got to look at the personal baggage we all bring with us every single time we sit down to trade. Because that, right there, is where the real problems actually start. This quote just nails it. Think of the market like a giant, unforgiving amplifier, right? If you've got issues with being impulsive, or you have a deep fear of failure, or maybe you have this burning need to always be right, well, the market is going to expose and magnify those traits like nothing else. It's basically a stage where all our internal dramas get played out, but with real financial consequences. The problems don't start with trading, they're just revealed by it. So what does this acting out actually look like? Well, Dr. Tharp created this investment psychology inventory test, which thousands of traders have taken, And from that data, he built a composite profile of the traits most likely to lead to losing. Now, as we go through this, see if any of these ring a bell. And remember, this is a composite. Most people only have a few pieces of this profile, not the whole thing.
So the key thing here is how all these traits feed into each other. I mean, think about it. If you're highly stressed and you're always expecting the worst, you're already starting on your back foot. Then, when you've got this internal conflict going on and you start blaming others, your broker, the system, those shadowy insiders, you completely give up your power to change anything. Add in no rules, a habit of just following the herd, and this impatient need for action now, and, well, you've got a perfect recipe for disaster.
So how do these general personality traits actually mess with your trading? Well, they show up as 5 very specific, very critical hurdles that consistently trip up traders who are trying to get better. Overcoming these is really the first practical step you've got to take toward success.
Okay, this first hurdle is a huge paradox and it explains so much failure. The #1 rule in trading is cut your losses short and let your profits run. It's a cliche for a reason, but most people do the exact opposite. When they're up a little bit, they get terrified it's going to disappear, so they become risk-averse and they cash out way too early. But when they have a loss, they turn into risk-seeking gamblers, just holding on and praying for a comeback, turning a small, manageable loss into a catastrophic one.
Next up is stress. We all know stress is bad for us, right? But in the high-stakes world of trading, it's not just uncomfortable. It is a direct saboteur of your thinking ability. Stress literally makes you a worse decision-maker.
Here's exactly how stress just wrecks your trading. Think of your brain as having a limited amount of RAM, or decision space. When worry fills up all that space, there's just no room left for good analysis. Your biological fight or flight response kicks in, and it narrows your focus down to just survival. You stop thinking creatively, and you just revert back to simple and often wrong patterns. You do what your broker says, or you just follow the crowd because it feels safe. You just want to do something, anything, to release that pent-up energy, and that leads to quick, irrational trades.
Now, this next one is a little deeper, but it's incredibly powerful. Dr. Tharp says that we all have different parts of our personality, and each part has a good intention. You've got a part that wants to make money, a part that wants to protect you from failure, a part that wants you to feel good. The problem is, sometimes these parts are working behind the scenes, subconsciously, and they end up in a head-to-head conflict with each other.
I mean, just think about how common this is. Half of the traders he works with are dealing with some kind of subconscious self-sabotage. For instance, he tells this story about a floor trader whose successful father was an alcoholic. So this trader developed a part of himself to protect him from being like his father. And the result? He could make about $75,000 a year. But anytime he made more than that, this protective part would kick in and just destroy his trading to make sure he didn't become too successful. It's wild.
And the last 2 hurdles are totally connected. Think about it. Most of our real-life decisions are slow and careful. Buying a car, for example, you research for weeks, right? Models, features, dealers. But the market demands fast decisions under extreme pressure. That slow analytical process just breaks down completely. And what rushes in to fill that void? Emotion. Fear, greed, hope, anger. They take the wheel and your trading plan goes right out the window.
Okay, so that was all the bad news. We've defined the enemy, we've laid out the hurdles, but this is where it gets really exciting. Dr. Tharp's work isn't about just dwelling on problems. It's about giving us a clear, actionable blueprint for success. It's a total paradigm shift away from trying to fix an endless list of things that are wrong with you. This is the absolute core of his approach, and it comes from a field called neuro-linguistic programming, or NLP. The main idea is called modeling. Instead of spending years trying to fix all your individual flaws, you just find someone who's already amazing at what you want to do, and you systematically break down how they do it, their beliefs, their mental steps, their physiology. You basically create a model of their success that you can then teach to anyone. It's like installing the software of success, not just debugging the faulty code you already have.
So what does this model of success actually look like for trading? Well, it rests on 3 fundamental pillars. And if you can really understand and start to adopt these, you can totally transform your results. These are like the missing pieces that most experts can't even explain, because for them, it's just automatic. What's so amazing here is how completely backwards some of these beliefs seem. Top traders believe money is not important. Now, why on earth would they think that?
Because when money is everything, you can't bring yourself to take a small necessary loss. They believe it's totally okay to lose because they know losses are just a part of the game. It's a business expense. They see trading as a game with rules, not some stressful job. And through tons of preparation and mental rehearsal, they have this deep confidence that they'll win in the long run. They aren't hoping to get lucky. They've already won the game in their mind before a trade is even placed.
All right, the second pillar is all about your moment-to-moment mental and emotional state. And this starts with taking absolute, total ownership. A losing trader blames the market, their system, Wall Street. A winning trader asks, how did I produce that result? They get that their impatience or their fear or their anger is the real source of the problem, and they know that their mental state is something they can actually control. And you can prove this to yourself right now. No, seriously, try this with me. If you're feeling stressed or just not on your A game, stand up, step away from your chair, and look back at it. Really see yourself sitting there, your posture, your facial expression. Now, create an image in your head of a more resourceful, confident you. How would that person look sitting there? See it clearly. Okay, now walk back, sit down, and physically embody that new posture. Feel that? The shift? Your emotional state can change almost instantly. You have way more control than you think. And the final pillar is about mental strategy, which is really just the sequence you think in. Just look at these two examples. They both start with seeing a trading signal, but the losing strategy immediately jumps to that internal voice talking about everything that might go wrong, which creates a bad feeling, which leads to hesitation and not acting. The winning strategy, it's way simpler. You see the signal, you recognize it's familiar from your research, you feel good about the opportunity, and you act decisively. It's the same starting point, but a radically different sequence and a completely different outcome. So when you put it all together, the beliefs, managing your state, the mental strategies, what is the ultimate key? What's the one thing that unlocks the door to real success? Well, it all boils down to one incredibly powerful realization.
And this, right here, this is the master key. This is the idea that changes everything. See, when you blame something outside of yourself, you are a victim. You have no power. But the moment you accept 100% responsibility for every single result, the good ones and the bad ones, you reclaim your power to change, to learn, and to grow. Winners know that they are the cause of their own effects.
So I want to leave you with this question. After everything we've covered today, from all the hurdles to the pillars of success, just take a second to reflect. What is the one single belief about money, about losing, about yourself that is acting as the biggest roadblock between you and your goals? Because just identifying it, that's the very first step to changing it. Thanks for watching.
Today, we're going to dive into a trader's very personal dilemma. It's all about that classic battle between knowing exactly what you should do in the market and actually being able to do it. It's a really gripping story about psychology, discipline, and one single trade that changed absolutely everything. I mean, just think about that question for a second. What if you've done all the homework? Your analysis is totally on point, and you know where the market is going, but for some reason, you just can't seem to make it pay off. It's got to be one of the most frustrating feelings in the world, and it's exactly where the trader in our story finds himself. And here's the paradox, right? This is the crazy part. On paper, this guy was a success. He'd multiplied his starting money by a huge amount, and not just once, but twice. By any normal standard, he was winning the game. But inside, he felt like a total failure, like he was just constantly coming up short of what he knew he was capable of. And this slide just lays out his frustration so perfectly. On one side, you have his knowledge. He was correctly calling these massive market moves again and again. But on the other side, his profits, they just didn't reflect that genius. There was this huge, infuriating gap between what he knew and what his account balance showed. And you can just feel the weight of that disappointment in his own words. It wasn't about losing money, you see. It was about the massive opportunity he was missing. He knew, deep down, he was leaving an absolute fortune on the table, and that knowledge was just eating him alive. This wasn't a technical problem. It was a deeply personal one. So how did this keep happening? Well, he was trapped in this vicious cycle. First, he'd spot a monster move, but he'd start with a position that was way too small, almost timid. Then, that fear of seeing a small win turn into a loss would just overwhelm him, and he'd sell way, way too early. He'd tell himself, "It's okay, I'll just get back in on the dip." But the dip never came, and he'd be stuck watching his perfect call play out from the sidelines. But then, something had to give. A real turning point was coming, and it was sparked by two incredibly intense conversations that forced him to look in the mirror and make a powerful vow to change his ways. So get this, on back-to-back nights, he has these deep, soul-searching talks with two giants of trading psychology, Dr. Van Tharp and Ed Seykota. And they didn't just talk about charts and strategies, they dug right into his mindset, his fears, his habits. It was like they held up a mirror and he was forced to finally confront the internal flaws that were holding him back.
And this was the result of those conversations, a deep, personal promise he made to himself. He decided right then and there that the next time one of these golden opportunities came along, he wasn't going to mess around. He was going to commit, see the trade through, and finally, capture the profits he knew were there for the taking.
And you know what? He didn't have to wait very long. Just 2 weeks later, he's on a plane to Chicago, and boom, it hits him. All the different pieces of his analysis just click into place, and he sees a trade so perfect, so clear, that it felt like the universe was sending him the ultimate test of his new resolve. So now he's crossing the threshold. He's moving from just talking about it to actually doing it. And his big challenge? A really interesting trade between silver and the Swiss franc. So what kind of trade was this exactly? It's called a ratio trade. Basically, the idea is you go long one asset, in this case buying silver, while at the same time you short a related one, selling the Swiss franc. Now, since precious metals and the Swiss franc often move together as safe assets, taking opposite sides like this helps hedge your bets. It's a pretty slick way to reduce your risk. It's a sophisticated strategy for sure.
And listen, this was not some random gut feeling. His analysis was incredibly methodical. He started by picking silver as the best precious metal to own. Then, he identified the Swiss franc as the weakest currency to sell against it. And after digging through a decade of charts, he came to this incredible conclusion. Their ratio was about to start a historic, multi-year climb. But of course, the market loves to throw a curveball, doesn't it? In a moment of just perfect, painful irony, he puts on the trade at the exact peak, right before it pulls back. The timing couldn't have been worse. But instead of panicking like the old days, he remembered his vow. When the price bounced back and then dipped again just like he planned, he didn't just hold on. He doubled down, making his position twice as big as he'd normally risk. This was a massive test of his new discipline.
And his courage paid off, big time. In just 1 month, his account was up over 30%. Just wow. This was it. This was the proof he needed. By sticking to his plan and having the guts to size up his bet, he was finally unlocking the true potential of his work. But, with great success comes a whole new problem, an incredible dilemma. His new philosophy, his vow, was telling him, hold on for that massive multi-year move you predicted. But this old, ingrained trading rule was whispering in his ear, hey, when you make a huge profit this fast, you take the money and run. It was like two powerful forces were at war inside his head. Now, the smart move here would have been to stop, take a breath, and do a deep, thorough analysis of the situation. But life got in the way. He had a brand new job, he was under pressure to write the very book this story comes from, and he was just plain exhausted. So instead of doing the hard work, he made a snap judgment based on his new vow. He decided to stay in. And the reversal was fast, and it was brutal. Within a week, a huge chunk of that 30% gain was just gone. And the man who had been so decisive just weeks before was now totally paralyzed. He couldn't decide whether to stick to the plan or get out and save what was left. He was completely trapped by his own indecision. And that night, trapped in this mess, feeling totally lost, the answer came from the most unexpected place imaginable, his own subconscious. He had a dream that was about to reveal the true lesson he desperately needed to learn. In a dream, he's talking to a friend about his whole dilemma, and the friend drops this absolute bombshell of a line, a quote he actually recognized from Ed Seykota. Everybody gets what they want out of the markets. I mean, what a profound, cryptic thing to say. It forced him to ask himself, what did he really want? Now, in this dream, his friend had somehow made an insane $18 million. So our guy asks him for the secret. You'd think it's some complex formula, right? Nope. The answer was shockingly simple, but so powerful. As long as I do my homework on the markets every day, his friend said, I am not concerned. The secret wasn't a magic trick. It was relentless, boring, daily discipline. And then
the dream's message got brutally clear. His friend does this quick calculation in his head and figures out that writing the book was earning our trader about $18.50 an hour. The implication was just stark. He was neglecting the work that could make or lose him tens of thousands of dollars for a project paying him less than $20 an hour. His priorities were completely backward.
And just like that, with that realization, he woke up. He had survived the ordeal, he had faced his own flaws, and he was coming back with the elixir, the ultimate trading lesson that had been just out of his reach for so many years.
So what was that huge lesson? Well, it all boiled down to these simple but profound truths. Number 1, there are no shortcuts. None. If you want to be great at something, you have to do the work. Every single day. You can't use not enough time as an excuse. You have to make the time. Because the price you pay for skipping that daily discipline, as he found out the hard way, is absolutely enormous.
And really, that brings this whole story back to us, doesn't it? Because this isn't just about trading. It's about potential. It's about the daily grind required to close that gap between who we are right now and who we know we could be. So let me just leave you with this. What's the homework in your own life that you're avoiding? What's the daily discipline that stands between you and your own true potential?
So what if I told you that one of the single greatest trades in history was triggered by a dream? It sounds wild, right? Well, today we are diving deep into the psychology of elite traders, pulling some timeless wisdom from the legendary book, Market Wizards. We're going to explore the mindset that separates the absolute best from everyone else. And it all kicks off with a story that feels a lot more like a prophecy than some dry financial analysis. So let's get into it.
Okay, picture this. The year is 1980. The corn market is just absolutely roaring. I mean, it's a speculative frenzy hitting record highs. And right smack in the middle of this chaos is a trader named Jerry. Our story starts right here, at a moment of just unbelievable risk that really blurs the line between a calculated bet and pure gut instinct.
Now that phrase, maximum possible long position, that's the key here. We're not just talking about a big bet. This is the absolute limit. The most contracts the exchange would let a single person hold. He was completely, utterly, 100% all in. Every chip on the table, betting that corn prices would just keep going up. The amount of money on the line, well, it's almost impossible to imagine.
So after weeks of writing this massive winning trade, his subconscious kind of decides it's time for an intervention. You know, during the day, our conscious mind is just filled with noise, right? Greed, fear, news headlines, what everyone else is saying. But at night, the part of our brain that's just a pure pattern recognition machine gets a chance to speak up. And boy, did it have something urgent to say.
So in this dream, he's basically interviewing himself. And his first answer, that's his conscious, bullish side talking. He still thinks the market has room to run, and he even has a specific price target in his head. This is the optimistic story he's been telling himself day in and day out. And here it is, the punchline. His subconscious just slices right through the optimism and gets down to the cold, hard math. It completely reframes the situation. It's not about the potential 8-cent gain anymore. It's about the colossal, insane risk he was taking on to get it. It was a risk-to-reward ratio that was just totally out of whack, something his emotionally invested conscious mind had completely glossed over.
He woke up in a flash. He didn't think twice. He didn't wait around to see what the market would do at the open. He got on the phone the very next morning and sold everything. And the result? It was just staggering. By listening to that gut feeling, he had perfectly, and I mean perfectly, timed the absolute peak of the market. And the book points out, if he had waited even a little bit, the market fell so fast he never would have gotten out of a position that huge without a catastrophic loss.
So, what do we make of that? Was it just a fluke, a random lucky dream, or was his mind piecing together information on a level he wasn't even consciously aware of? Well, this very story is our doorway to understanding the principles that truly define the world's greatest traders. You see, that story really reveals a fundamental truth about trading. It's not about some magic signal or a secret formula. Success in the markets is, overwhelmingly, an inner game. It's all about mastering your own psychology, your ego, your fear, your biases. The real battle isn't against the market, it's against yourself. Jerry's dream wasn't magic, it was intuition. And what is intuition when you really break it down? It's simply the sum of all your experience processed subconsciously.
After years and years in the markets, his brain saw a pattern, a market that had gone too far too fast, where the reward just wasn't worth the risk anymore. It felt familiar, like other market tops he'd seen before. He didn't consciously know why he felt so uneasy, but his subconscious absolutely did.
Okay, here's a huge mental shift that separates the pros from the amateurs. A good trade is not the same thing as a winning trade. Think about it like this. What if I offered you 2-to-1 odds on a simple coin toss? Taking that bet is always a good decision. That's a good trade. Even if you lose the first flip, you'd be a fool not to take that bet every single time, because over the long run, the process is guaranteed to make money. You have to focus on the quality of your process, not the random outcome of any single event.
And this quote just hammers that point home. Elite traders know that losses are just part of the business. They're not negotiable. As long as that loss came from following your plan, from a strategy that you know has a positive expectancy, then it's just the cost of doing business. It's not a personal failure. Getting this right is absolutely crucial for detaching your ego from your profit and loss statement. It's all about playing the long game.
I'm telling you, your ego is your single worst enemy in the market. The market has zero memory of where you bought in, and it certainly doesn't care about your feelings. That desperate little prayer to just get out even, that's pure ego. It's our tendency to hold on to losers, because admitting we made a mistake is painful. And averaging down on a loser is even worse. You're just turning a small, manageable mistake into a potential catastrophe, all because your ego can't stand the thought of being wrong.
Okay, so if that's the mindset, how do the top traders actually put this stuff into practice? Well, that brings us to the outer game, the practical, actionable strategies and risk management techniques that these traders use every single day.
0.1%. Just think about that. That is an astonishingly small amount of capital to risk on a new idea. Now, that specific number might be extreme for most people, but the principle behind it is universal. You have to be incredibly protective of your capital when you're testing out a new trade. Your first job always is just to stay in the game. Only after a trade moves in your favor and gives you a nice profit cushion should you even think about giving it more room to breathe.
This right here is an absolute game changer. Everyone obsesses about finding the perfect entry price, but the wizards know that how much you bet, your position size, is way more important. Why? Because if your position is too big for you psychologically, every little tick against you is going to feel like an earthquake. Fear will completely hijack your brain, you'll throw your plan out the window, and you'll almost certainly make a terrible decision at the worst possible time.
Here is a brilliant little psychological trick for whenever you feel stuck. You're in a losing trade. You know you should probably get out, but your ego hates admitting defeat, so you just do nothing. You're frozen. The solution? Don't think about it as all or nothing. Just sell half, or maybe even just a quarter. This simple act breaks that emotional paralysis, it immediately reduces your risk, and it lets you look at what's left of the trade with a much clearer, more objective mind.
The best traders are not static. They don't just set it and forget it. They are actively managing their winning trades in a process sometimes called trading around a core position. So when a trade is working really well, they might sell a piece to lock in some profit. That makes it way easier psychologically to hold the rest for a much bigger move. Then they might look to add that piece back if the price pulls back a bit. It's a very fluid, very dynamic process. So, what's the common thread through all of this? I mean, the traders in this book have wildly different styles. Some are day traders holding for just minutes. Others are trend followers who might hold for years. Some use complex charts. Others look at fundamental economic data. But underneath all of that, they all share a core set of timeless principles. Just take a look at this list. A burning desire to succeed, unshakable confidence, rigid risk control, patience, independence, accepting that losing is just part of the game, and they genuinely love what they do. Notice something? None of these are about having a genius-level IQ or finding some secret algorithm. It's all about mindset, it's about character, and it's about discipline. This is pretty much the psychological DNA of a master trader.
The composer Claude Debussy once said something really beautiful. He meant that the silence, the pauses between the notes, are just as important as the notes themselves in creating the music. And that's just such an elegant metaphor that applies perfectly to the markets.
In trading, your most profitable position is very often just being in cash. That space between the trades, that time you spend patiently waiting on the sidelines, protecting your capital, not chasing mediocre setups, that is where a real edge is found. There was one manager in the book who had incredible returns for a decade, and he did it mostly by just stepping aside and holding cash during bear markets. Sometimes the best action you can take is no action at all.
And this all brings us to the final
And maybe the single most important lesson from all of this. After studying dozens of the world's greatest traders, the author of Market Wizards came to a really powerful conclusion, and it's probably not what you think it is.
You see, the ultimate secret is that there is no secret. There isn't one holy grail system that works for everybody. The real journey isn't about finding the perfect system to copy. It's a journey of self-discovery. It's about finding a method that lines up perfectly with your own unique personality, your tolerance for risk, and your own time frame. Real, lasting success comes from deep self-knowledge.
And that right there brings us to our final thought, one that goes way beyond any trading screen. This idea of finding an approach that fits you applies to everything: your career, your relationships, your life. Are you following a path just because you think you're supposed to, or because it genuinely clicks with who you are? The ultimate lesson from the Market Wizards isn't just about how to trade, it's about how to think for yourself.